this recording?
बहुत जरूरी है विवेक.
So thank you, friends. I think we should start. We have 260 people waiting eagerly to listen to the changes in budget, although there was no major change in salaries as was spoken in the budget, and it was only thank you for the masses. We have first a small announcement, friends. Due to unavoidable reason, Dr. Girish Ahuja ji was not able to join us today. So Bhupender Shah sir will be taking us through the complete direct tax. And we have CA Jatin Harjai ji because we got request that there are some changes in the indirect tax, not only in GST, but in customs and others. So Jatin Harjai sir will be speaking on the indirect tax. Friends, this program is jointly organized by 5 associations of Calcutta. And I, President of ACA, welcome you all for this budget session of 2022. This budget session has been important because in virtual world, we thought, why not give the opportunity to everyone to have an in-depth discussion with our speakers. And we have with us CA Bhupender Shah sir for the same. Friends, ACA is one of the oldest association of Calcutta with a history of 62 years. And various stalwarts have been part of ACA. And with this, I hand over the proceeding to Bajrang Lal Agarwal ji, President VIP.
Thank you, Vivek. Good morning, good afternoon, my dear fellow friends, senior colleague, and our speaker of the today's session, CA Bhupender Shah from Mumbai, in absentia CA Jatin Harjai from Jaipur, and Miss Shivani Sarkar Kurian from Mumbai, who will deal with the capital market. Friends, today this budget is very important. We are discussing all in depth about the budget seminars. I hope all the members, delegates who joined today virtual platform via Zoom, YouTube, and Facebook will get benefit from today's sessions. With these words, I introduce our association. Our association is very old study circle in ERC, established in 1997. The members' strength already crossed 850. All are the chartered accountant. With these words, I invite C.S. Saroswaika, President of Views Exchange of India, Views Exchange, a study circle. Thank you.
Thank you, Bajrang ji. Good afternoon, everyone. Welcome, friends, honorable speakers, and all our other delegates. I am Saroswaika. A little bit correction for Bajrang ji. I am Vice President of Views Exchange, not President. President is Naveen Khemka. Views Exchange Study Circle, EIRC. I welcome all the eminent speakers and delegates from all over the country who have joined in here to share their knowledge and vast experience. I feel proud to say that this seminar has been organized by various professional forum of Eastern India, including NCLT, Eastern region. The motto for such seminar is to enlighten all of us with respect to the various keynotes, takeaways, and viewpoints of eminent speakers. With all these words, I bid a very warm welcome to CA Bhupender Shah ji, CA Jatin Harjai ji, and Ms. Shivani Sarkar Kurian, who took out their valuable time and joined us today to be a part of this seminar. We are honored to have you all with us. We are grateful to all of them for accepting our invitation and becoming a part of today's event. I would also like to thank all the participants today for joining today's budget seminar. I guarantee that the seminar will be productive and worth your precious time. Thank you all. Yes, Bajrang ji.
Now I would like to invite CA M.R. Bhatt, President of South City Study Circles.
It is South City CA Circle. Yeah. Thank you so much. Thank you. Distinguished panelists, CA Bhupender Shah, CA Jatin Harjai ji, Madam Shivani Sarkar Kurian, members of the various CA study circles and the NCLT Bar Association, ladies and gentlemen, a very good afternoon to you all. I welcome you to the webinar on Decoding Budget 2022. We all eagerly wait for the budget every year, considering the impact it has on our lives. And obviously, this year is no exception. To take us through the fine print and the nuances of Budget 2022, we have eminent speakers, and I can't wait to hear them. I am sure everyone present at this webinar shares my feelings. I now request Shri S.M. Gupta to please continue with the proceedings. Thank you.
थैंक यू बात जी। ये बहुत बड़ा मौका है और बहुत सुखद अवसर है हम सबके लिए कि इतने एमिनेंट स्पीकर्स जिनको हम स्वागत करते हैं, गेस्ट फैकल्टी तीनों को, वो आए हैं और 1500 से ऊपर का इस गैदरिंग में वो एड्रेस करेंगे। तो आप समझिए कि ज्ञान का कैसा वितरण होगा आज। इनकम टैक्स, डायरेक्ट टैक्स और इनडायरेक्ट टैक्स दोनों के दिग्गज स्पीकर है जो गेस्ट फैकल्टी है। और दूसरी बात, जो संस्थाएं एक साथ मिलकर के ये काम कर रही हैं, ये भी देखिए एक अपने में एक बहुत बड़ा संगम है। तो ये संगम हमेशा चलता रहना चाहिए। और इससे क्या फायदा होता है कि स्पीकर को भी फायदा होता है, गेस्ट फैकल्टी को भी, और संस्थाओं को भी फायदा होता है, और हम लोग अटेंड करने वालों को फायदा होता है कि हम लोग सब स्पीकर को सुनना चाहते हैं। तो 5 संस्था 7 संस्था एक साथ मिलकर सुनाए तो हम लोग को भी यहाँ से वहां बार बार लॉग इन लॉग आउट नहीं करना पड़ता है। अच्छा, हमारी संस्था के बारे में हम खाली 2 शब्द बोलेंगे। वो ये है कि एनसीएलटी कोलकाता बार एसोसिएशन मेरे ख्याल से इंडिया का एक अनूठा एसोसिएशन है, जो कि वी एडमिट CA, CS, cost accountant and advocates all, because Companies Act provided that all these 4 persons categories can appear before NCLT. So other bar associations in India, to my knowledge, are only for advocates, but this bar association admits all the 4 categories. And when we went to the society registrar for this purpose, he did not believe. He says it can't be, because I have not seen a bar association where chartered accountants can be admitted. So I showed him the Companies Act, the NCLT rules and everything, and then with great difficulty we got registered. So we welcome all the 4 categories to become our members, and this is a unique association in Calcutta, NCLT. So welcome everyone, all faculties, all participants, and all the institutions who are joining together. Thank you very much. Anup Sangai ji, please now, please. Anup Sangai ji, please.
Am I audible, Gupta
Yes.
uncle?
Yes,
Okay,
yes,
thank you.
yes.
Yeah, okay. Thank you very much, SM Gupta uncle, a very senior CS professional, eminent CS personality in Kolkata and President NCLT Bar Association. I'm indeed thankful to my alma mater ACAE Association for giving me this opportunity. I am representing ACA in its immediate past present capacity. I am CA Anup Sangai. I welcome CA Bhupendra Shah for this budget seminar, which I believe each and every audience will be going to hear. CA Bhupendra Shah from Mumbai does not need introduction to the audience at Kolkata, neither audience across India. However, it is very customary to introduce any eminent personality before a learned gathering. So this opportunity I'll be getting. CA Bhupendra Shah is a commerce graduate and FCA from is a commerce graduate from Sidnam College, Mumbai, and he's a fellow member of Chartered Accountants. He's is in CA practice since 1981-82. His merit position in SSC board in 1973. He's completed his ISA course in June 2005. In 2015, he was appointed as a special invitee to the PDC committee by our own ICAI president. He was appointed as a reviewer of tax audit by the Quality Review Board of ICAI. He has delivered many lectures at DTRTI of IT department for and in front of departmental officers, and he has delivered many lectures and attended seminar. Attended means he has delivered lectures at all the seminars, and the list is very, very huge. If I read it out, it will take a long time to read all this list where he has delivered his lectures. He drafted, he is expert, his domain expertise is direct assess, drafting, consultations, appellate work, up to CIT appeals and tribunal level, search and seizure matters, and family arrangements. He is already a peer reviewer of the peer review board for ICAI in the panel of FRRB of ICAI, appointed as a resource person of CPU of ICAI. Friends, this list is a long list, and I could only pick out some of the points in the credition of our very valued speaker, CA Bhupendra Shah. So I would not take too much of time for introducing our very learned speaker, CA Bhupendra Shah. Over to CA Bhupendra Shah for this wonderful session. We'll be waiting. All our audience is anxiously waiting. Over to CA Bhupendra Shah from Mumbai.
Hello, can you see the screen?
Yes, sir. Your screen is,
Yes, sir.
Ma
Yes, sir.
Saraswati is visible,
Yes.
sir.
Visible?
Yes.
Okay.
Yeah.
Yes, sir.
Good afternoon, everybody. Today we have assembled together knowledge, and the knowledge is given by Goddess Saraswati. So with her blessing, we start our deliberations. Vagratunda Mahakaya Suryakoti Samaprabha Nirvighnem Kurvime Sarvakareshu Sarvada. Today I will be speaking only on the Finance Bill 2022, and that too only proposals related to direct taxes. So this is me before you on a virtual mode, speaking from Mumbai to you all over India. First thing we have to notice is the first time in the history of Indian budgets, physical budget was removed and dropped. It was all digital. So now only digital copy and no physical copy was made so far as budget 2022 is concerned. This reminds me of one stanza from our old epic Shastras. Pushpam pushpam vichin with mula chedam na kare, malakar ivara me no yathangar kar kaha. Meaning by a king must extract tax from his subjects, that is population, just as painlessly as honeybee extracts nectar from any flower. He must act like a florist who plucks the flowers but takes good care of the plant in return. He must not be like a coal miner who destroys the source of his income day by day, time and again. Now, first and foremost thing we have to notice and observe from Finance Bill 2022 that most of the people are always interested that what is the change in the slab rate? What is the change in the basic exemption? What is the change in corporate taxation? What is the change in standard deduction? So Finance Minister says nothing doing, slabs have remained same because in 2014 onwards, they have promised that so far as tax laws are concerned, there should be uniformity and consistency from year to year. They have definitely avoided this type of changes. So tax rates have remained same, basic exemption is same, no change in the corporate tax, no changes in standard deduction. So many of the so-called middle class or salaried class people are definitely expressing their grudge and dissatisfaction. But that's not a correct thing. In fact, if the laws are consistently implemented, so in that case, there is a more value addition to the law because you don't have to study the nitty-gritties. But apart from this, if you study the fine prints of law, there are n number of changes. I found at least more than 70 changes. We will discuss at least 25 to 30 important changes which affect you people as a practicing professional. Most important amendment which I found in the Finance Bill 2022 is related to revision of return. the Honorable Finance Minister in her speech. By the way, this was the shortest speech ever given by her. So I was little wondering that why it is so short. But then as I started reading in depth, then I found out that there were so many things which she has not mentioned in the budget speech, but they are coming out. So let us see few of them. She mentioned updated return under section 139(8)(a). Now this is a new proposal visualized and proposed by the finance minister. What are the salient features? Number one, income tax return now can be revised within 2 years on payment of additional tax. So here we have to hold. That means if you think that you have forgotten some claim, deduction, rebate, etc., which will result into some sort of no payment of tax, but more refunds or more benefit, then this is not for you. The situation is very clear. Only on payment of additional tax, you can file updated return under section 139(8)(a). So this is just like your 148. 148 is for the benefit of department. It is not for the benefit of assessee who is forgotten to show something in the return. Now, proposal runs like this, that amount equal to 25 or 50% as the additional tax on the tax and interest both. Mind you well, now after 26 AS, there is AIS information. As you are all aware, in that information, something comes up new after you file the return, that you have not shown particular income. You are free to revise your return, but what is the rate of tax? Normal tax plus interest 234 ABC is applicable, plus 25 or 50% additional tax. So I really wonder how many people will file updated return under section 139(8)(a). Now 25% additional tax is to be paid if the return is filed after the expiry of the time limit under section 139(4) or 5, but within 12 months from the end of the assessment year. So, and otherwise it is 50. Beyond 12 months, it is 50%. So I am really skeptic whether it will have any fruitful effect, because 33%. And in some of the high tax payers, it is 42% tax also, plus interest, plus 25% or 50% additional tax. So it is as good as surrendering or whole of your income. And it is nothing but a penalty without any assessment. Anyway, but even this type of facility can be always availed of by all, but following persons cannot avail of this facility. Number one, this section shall not apply to the return of a loss. That means, for example, why it cannot apply to loss? Because sections are very clear that loss returns have to be filed in time. Otherwise, some people who have forgotten to claim loss, they will claim loss and then apply. Okay. Then second is that if the effect of decreasing the tax liability. No, it cannot decrease the tax liability. Because I told you that suppose if you have forgotten to claim some, etc., then you cannot do that also. Then thirdly, results in a refund. That means by claiming something extra. For example, you have forgotten to claim, say, ATIA 4. You have forgotten to claim ATIB 4, etc. Then in such cases, it will result in refund. And refund cannot be claimed under return under section 139(8)(a). Next is a such cases under section 132 or requisition of books and documents under section 132(a). survey under section 133A, but other than the surveys under section 133A to A. So survey under section 133A is also debarred so far as updated return under 139.8A is concerned. Now similarly, when a notice is issued that any money, bullion, jewelry or valuable article is seized under section 132 or under section 132A in case of any other person belonging to such person. For example, you are directly raided or in third party's raid, your notice is issued to explain some, say you are carrying 1 crore rupee cash and you are found with the cash. Then also you are not eligible for filing updated return under section 139.8A. Next, disqualification is a notice has been issued to the effect that any books of account seized or requisitioned under 132 or 132A in the case of any other person pertain to or any information contained therein relates to such person. For example, some third parties search, my documents are found, then also you cannot avail of 139.8A. And next is that this provision is for the assessment year relevant to the previous year in which such search is initiated or survey is conducted, and also to assessment year preceding such assessment year. So section disqualifies so many people mentioned above. Now further, as if this was not enough, the finance minister goes further that once you have filed updated return under section 139.8A, again you cannot file second return under 139.8A, because many people, they will say that I have got bogus share capital, I am filing updated return 139.8A. Again some bogus loans are found, again some bogus donation is found. You cannot go on revising endlessly. So 139.8A is a one opportunity, it cannot be again availed second time. Now any proceeding or assessment or reassessment or revision of income is pending or has been completed for the relevant assessment in this case. That means suppose 148 is issued, then also you cannot do it. Revision proceeding 263 is pending, 148 is pending, 143.2 is pending, or it is already completed, then you cannot file updated return under section 139.8A. Now further, AO has information in his possession that which is already communicated under Prevention of Money Laundering Act. Then similarly under BMITA, PBPTA, that Benami property, smugglers for action, all such act which are other than the Income Tax Act, but assessing officer has the information, then you are debarred from filing. For example, you are found with Benami property. Initiating officer has already communicated to the assessing officer, then you cannot go under 139.8 and regularize this. Otherwise, it will defeat all the acts mentioned therein. Okay. Now, next portion is that information for relevant year has been received in an agreement in 1990, double taxation, and the same is communicated. Then also you cannot, from foreign country, some information is received. Any prosecution has been initiated. It says initiated, not concluded. Even initiation of proceeding of prosecution will debar you from filing 139.8A. So, and lastly, as if this is not enough, it says any other circumstances or persons or class of persons CBDT may notify. So effectively, according to me, only honest, genuine and bona fide errors which have occurred under 139 can be rectified under section 139.8A. Now, another section 139.9 is also amended, that return filed under section 139.8A shall be defective unless you pay the taxes thereon. That means it is like your IDS. You remember, Income Disclosure 6, 2016. There also mere filing of form was not enough. Payment of taxes are more important. Similarly, in the case of Vivad Se Vishwas, unless you have paid the taxes and inform under Form 4, you will never be given Form 5. So here also, unless you have paid additional tax, you will not be eligible to get any relief under Section 139(8)(a). That return will be non-est. Yes, now here we start again. Section 14(a) is amended. Section 14(a), you know very well. Each and every limb of 14(a) was full of litigation, and on each and every word there were case laws, and 90% were in the favor of assessing. Now, for example, in the case of Came Invest Limited, what happened? Delhi High Court say and held that if you do not have exempt income, where is the question of any disallowance? Similarly, in the case of Infrastructure Leasing and Finance Energy Development Company, 250 taxman.com 174, it was held that unless there is an exempt income, there is no question of application of 14(a). Now, these all judgments have been completely overruled by amendment to Section 14(a). And Section 14(a) has been made a non-obstant clause. Non-obstant, the words are very heavy. What is the plain English? Without prejudice to whatever is stated in any other section of the Act. That means 14(a) is a stand-alone section, and further an explanation has been inserted with effect from assessment at 2022-23. That means the year which has already started and about to end in 1 month or 2 months will also be covered. That is assessment year 22-23. That expenses can be disallowed. Actually, it says shall be disallowed. It does not say can. Shall be disallowed irrespective of the fact whether non-exempt income is earned or not, or exempt income is earned or not. This is irrespective. Okay. So exempt income is not the criteria, and all the judgments have been overruled from assessment year 22-23. Now, Section 37. This is a very important section, and some people have asked some queries on the chat box. So I am already covering here, so they may listen to this. Any expenditure incurred in respect of offense committed outside India. Earlier, what used to happen? If suppose you have committed some offense outside India, then proviso to Section 37 debarred only those expenditure which are incurred in India. Now, this section is specifically amended to include any expenditure which is incurred outside India but claimed in India under Section 37. So that will be now disqualified. Secondly, this is very, very important. Any perquisite provided to a person wherein the person is prohibited from receiving such perquisite shall be disallowed under Section 37. Here, I will tell you, so many doctors, medical practitioners, they were given free international trips, so many with families, friends, relatives. In the name of seminar, they were enjoying foreign trips, which was nothing but a perquisite. And in the name of seminars and freebies, they were allowed to enjoy the benefits. Now that is not allowed, and Section 37 is amended. So this will have an impact on all the, let me tell you, there was a severity circular which stated that Indian Medical Association is not permitting a doctor to avail such freebies from the pharmaceutical companies, so that it amounts to breach of ethical standards of medical practices. However, so many judgments, and which is the most prominent among them? MacLeod Pharma delivered on 14th October 2021. All earlier orders of various tribunals have been considered, and it has been stated in the MacLeod Pharmaceutical by way of a cautionary note to the central government that this type of freebies to the doctors have led pharma company to reach huge profit. Secondly, medical costs have gone up. And thirdly, this is against the ethical practices, so it may be curbed. Listening to this judgment of MacLeod Pharmaceutical, the government has acted very quickly. Imagine October 21 and now it is just January end and February beginning. Within few months, they have taken a note of this. But saving grace is that it will be effective from assessment year 23-24. So 2 months, all these medical practitioners can still enjoy the freebies. And second amendment was regarding offenses committed outside India, any expenditure. This will not be allowed. Last year we saw that depreciation on goodwill and everything was covered under the amendment. Now there was a consequential amendment which was needed. So reduction of goodwill from the block of the assets now to be treated as a transfer. For the purpose of section 50, reduction of amount of goodwill of any business or profession will be construed as a transfer, and that too with effect from 21-22, my dear friends, 21-22. Today we are in assessment at 22-23. Next one. This is of very much importance to those who are dealing with shell companies, hawala companies, bogus share capital, bogus premium, bogus loan, bogus donations, and whatnot and whatnot. Scope of 68. You are aware that section 68 has been amended drastically in past few years. It included that source of source has to be proved in the case of companies in which public are substantially not interested. That means in the case of share capital, share premium, section 68 requires now to provide for explanation of not only the share capital and share premium, but of the source of this share capital. Now I'll give you one example. Suppose I am a private limited company. I have taken share capital and share premium from B private limited company. And B private limited company has given me all the confirmation, bank statement, ITR, everything. What I used to say, that I have explained the source, and Lovely Export Limited Supreme Court judgment applies, and I don't have to explain source of the source. Thereafter, several cases, including Rajmandir of Calcutta, including NRA Steel of Supreme Court, etc., reversed all this earlier judgment and stated that source of source in some cases may be required to be explained. Accordingly, section 68 was amended, but still one lacuna was left. So what people started doing? People started taking loans which were from shell companies, because in the case of a loan, Orissa Corporation Supreme Court judgment states that you have to explain only the source, not the source of the source. Similarly, in the case of Exxon Global Private Limited, 2022, recently, jumped few days back, 134 taxman.com, 256 Delhi. These also held that source of source is not required to be proved in the case of loans. Now, Finance Minister says nothing doing. With effect from assessment year 23-24, even loans and borrowings are also covered under section 68. That means, for example, I am Bhupendra Shah. I have taken loan from Mr. ABC. I have explained my loan from ABC. That's not enough. I have to further explain the source of ABC also. This I feel is little harsh. I am 100% sure that just like litigation on 148A and 148 last year, as soon as this act is passed, as soon as notices are issued to prove source of the loans and borrowings also, I am pretty sure that judiciary will take a judicious view that in the case of loans and borrowings, the situation is different. I had argued one case under section 56(2). One ITO added loan as an income under section 56(2) by holding that it is interest free under amended 56(2) because there is no consideration, so it is interest free, so it is income of the appellant receiver. I argued at length and proved before the honorable tribunals that repayment of loan itself is a consideration. Contract Act says that consideration is must, but repayment itself is a consideration. So when repayment itself is a consideration, why should I prove source of the source? That my loan giver should prove that from where he has taken the loan. I am sure that this type of amendment of 68, so far as loan is concerned, may not stand good standing in the judiciary in the times to come. So this is now another round of huge litigation will start on this. Anyway, this is my personal view. Next, now as you can see, one penguin is beating another penguin. So first penguin is a actual currency and second is a cryptocurrency. So there is a competition between two penguins. Now let us see what is all this virtual. I don't like this heavy definition. Simple English में बोलने का. What is cryptocurrency? कुछ नहीं है. It is journal entry. A to B, B to C, C to D, D to E. Journal ledger is kept online and funds are transferred. Just as your couriers. Once you give money to courier, does he transfer the money physically? No. He just tells that give 5,000 rupees to Mr. X in Bombay. Give Mr. 5,000 to Mr. B in Delhi. Like that. So virtual digital asset. Now this is a new concept under Income Tax Act. As a chartered accountant, you have studied real accounts. As a practitioner, you always argue real income theory. But now, virtual digital asset, very interesting. New section 115 BBH. Now, government has acknowledged existence, but tax is to be borne. There's a spelling mistake, borne. Tax is to be borne. Government has now realized it is like cancer. Howsoever you may hide, cancer cannot be cured. So it has to be effectively handled like that cryptocurrency. There is an existence recognition, but with tax. Today morning, I was reading papers, newspapers, in which I read that 28% GST is likely to be imposed on transfer of virtual digital asset. Now, what is the income tax on this now proposed? Any transfer of cryptocurrency, flat rate of 30%, even though your income may be zero. But once you transfer virtual digital asset, 30% plus surcharge and cess. So it can go up to 42% also. But of course, deduction of cost will be allowed. So sale price minus cost into 30% plus surcharge and cess. Now, no expense will be deductible. Nothing. No brokerage, no commission, no other business expenditure, nothing. No set-off of losses. Further, losses will not be allowed to be carried forward with effect from 23-24. So this is very, very drastic provision coming into the picture. That is why I was just prompted to put two penguins like this, one hitting other like a death knell. So jao bhaiya, aisa seedha. Now, some people may think, I will not sell, I will give gift to some person. Nothing doing. It is already covered under section 56 to 10. Now, virtual digital asset is one type of property postulated under section 56(2). But saving grace is that it will be effective from 23-24. तो अभी 2-3 months बाकी है. अभी इतना काफी नहीं था. As if this was not enough. Then what has been done? TDS is introduced. I think now TDS is the only earning son of income tax department without any effort. 194S. You know, 194O, 194Q, there is some purchase, sales, then equalization levy. Many people are still not aware. They are merely doing the business and auditors are not even qualifying the reports. They are into deep soup because they are caught by the system. Here also, on a transfer of crypto, 1% TDS is imposed. And now, even in the cases, you may think that it may be partly cash, partly kind, or fully in kind. Still, the buyer has to ensure TDS. There is no exemption at all. But only threshold limit, that is 50,000 under 56 to 10 and 10,000 for others. It is effective from 1/7/22. Remember, taxability is from 1st April. But TDS is always 3 months later because the website, it will itself not have the provisions of TDS and people will start complaining. So they have provided from 1 July 22. Now, wherever tax is required to be deducted under 194O as well as 194S, then tax will be deducted under section 194S and not under 194O. What does it mean? 194S is a priority section. 194O is a subsidiary section. So, my dear friends, just summarizing, crypto is an asset, 30% tax, 1% TDS, gift is taxable, 30% tax, and 50,000 basic exemption, and priority is to 194S and not to the O. Faceless proceedings, yes. Now, many people are so much disgruntled with faceless. There may be various reasons. Number one, because of complexity. Second thing, because of the lack of knowledge on the part of the assessing officer. And thirdly, sometimes out of ignorance, haste, or vengeance, high-pitched assessments have occurred. Now, coming back to faceless proceeding. Now, government has extended the time limit for notifying the faceless schemes. Already announced, but deferred. Transfer pricing, then DRP, tribunal, income tax tribunal, till March 24, there will be no faceless schemes of ITAT, DRP, and TP. After 31st March 2024, what will happen? In the morning, you get up. You do not know before whom you have to argue the case. It will be online and they will not be able to know who you are. So this is the scheme of the act which is deferred till 31st March 2024. Now, faceless assessment. Now, this is another bone of contention on which lots of litigations have taken place. Now, new section 144B. For example, default of personal right of hearing, or the alterum pede, what we say, that my natural right is snatched away by not giving me link for video conferencing. Then 144B9 was there. It mentioned that assessment provision about the non-age point is now rolled back retrospectively. That means you are at a mercy of now faceless officers. For example, it does not give you video conferencing, which is mandatory. The assessment is not null and void. Maximum court will say, okay, you grant them video conferencing. So this is totally against the actual spirit of faceless assessment. Now section 144B(9) is omitted. What it provided, that any proceeding shall be void if 144B procedures are not followed. One of the procedures fall, show cause notice, video conferencing, this, that. So if they are not followed, it can be declared null and void. And several cases, for example, DJ Sarfangton versus National E-Assessment, Delhi, SAS Finvest, Delhi, the KL Trading Corporation, etc., Delhi, all these declared null and void. But now with the amendment of this section itself, and it is amended with effect from 1/4/2021. That means the day on which the scheme was introduced. Now, reassessment proceeding. Everybody was very, very anxious that whether any amendment has come in 148 or 148A, under which several litigations are going on. Calcutta High Court, Delhi High Court, then Rajasthan High Court, they upheld the fact and the law that no opportunity given under section 148A in respect of the notices issued after 1/4/21 makes the assessment null and void. Some High Court stated that yes, but 148A can still be invoked by way of second inning. Now, ultimately, against the judgment of Allahabad High Court, the government has already filed hundreds of pages filled SLP before the Supreme Court. Now, everybody was expecting that there will be some amendment in the budget itself, that is the Finance Bill 2022, so as to regularize all these notices, but nothing has happened. Now, what are the amendments in reassessment proceeding? Let us discuss one by one. One of the proposal is that under section 148, no approval is necessary. Why no approval is necessary? Because when you already passed the order under section 148A(d), that is already with the approval of superior PCIT and higher ups, then in that case, there is no need of further approval. Then the requirement of issuing notice is done away with. So this is nothing but a clarification. Now, another dangerous amendment. What we were taught last year, that any information which is flagged either from audit party or from system generated ITBA system of Income Tax India. Now, word flagged has been removed. So, it is whole ocean is open now. Now, information under section 148 explanation 1 can be the audit objection, information received from foreign jurisdiction, information received under scheme of notified under 135A, several sources. Now, whole ocean is open. Now, 148A shall exclude the information received by the AO under the faceless collection of information of section 135A. Only that is a saving grace. Now, coming further, amendment to section 149, that is time limit for 148. Now, notice under section 148 shall be issued after 3 years but before 10 years. In the case the AO has books of account, other documents revealing income chargeable to tax represented in the form of an asset. So earlier only this was the provision, but now it has included expenditure. For example, 69C or in relation to an event or occasion or an entries in the books of the account. So now asset word is sidetracked. So all your share capital, share premium, loan, sundry creditor, bogus donation, bogus sales, bogus purchase, bogus expenses, everything under balance sheet and profit and loss account is fully covered. But the saving grace is, again, this is effective from assessment year 23-24. I know on this you got lots of queries. When the queries come, I will deal with them. Again, reassessment proceeding. Much anticipated amendment to 148 or 149 has not been brought in the Finance Bill 2022 in order to nullify the orders of the High Court. As I told you, Delhi High Court of Mohan Kohli, which somebody wrongly represented as a Supreme Court. This is the ill effect of overuse of technology to hoodwink the people of India. Actually, it was Delhi High Court, and somebody, not even some unknown person, well-known website represented this as a Supreme Court judgment. Then Allahabad, Ashok Kumar, Rajasthan High Court, BPIP Infra, Calcutta High Court, Manoj Jain, and hundreds of cases. They are not dealt with by the amendment in Finance Bill 2022. Yes, now there are so many repetitive appeals. So the Finance Minister said the government agrees that we will not file repetitive appeals under section 158AB. But there are conditions. Yeah, the similar issues should be pending before Supreme Court or a jurisdictional High Court. For example, I am in Bombay. I cannot say some issue is pending before Calcutta High Court, so I will not allow my ITO to file repetitive appeals. No. Either Supreme Court or jurisdictional High Court. Now there will be a collegium. Collegium means group of 2 or more commissioners, principal commissioner, chief commissioner, or CIT, etc. shall be established. Now proposed section says that the directions of the collegium will be obtained. They may defer the filing of the appeal to ITAT or High Court, where the question of law is pending before jurisdictional High Court or Supreme Court. Now, deferment of appeal is subject to one condition, that approval of the assessee has to be obtained in writing that the case is pending before the jurisdictional High Court or Supreme Court. So onus is on assessee to request the officers not to file or defer the filing of revenue appeal before ITAT, High Court, etc. on the similar issue which is pending before jurisdictional High Court or Supreme Court. Option to file the appeal once the question of law settled is available with the AO. Naturally, if the assessee loses, then again he can file. Now, no direction under section 158AA shall be given or after 1422. So these are sunset clauses. This is a very important clause. Multiplicity of litigation is avoided. So those people who made 148 as a tool for writ petitions is now severely cut down here. Okay, next. Yes, if you have to tell me or ask me which is the worst provision of the Finance Bill, I would say without hesitation that reintroduction of power of survey under section 133A is the most draconian power restored with the office of AO. I will tell you how. Now see how the assessee is running away from the officer once the survey starts. Finance Bill proposes to amend Income Tax Authority, and subsection 6 provides that any authority subordinate to principal director, general or DG or PCC or CC as specified by board as against existing provision of principal director, DG or TDS principal CC or CC. That means your jurisdictional officer can go to his CC and say that this party is worthy of survey. Actually, according to me, this will lead to rampant misuse of powers. With great difficulty, after 1961, powers of survey were curtailed and restricted to the highest authority, that is investigation and TDS. But now they are again restored to the jurisdictional principal chief commissioner, CC, DG, etc. On one hand, government states that faceless assessment and faceless appeals are necessary so as to avoid, in the words of our Prime Minister, safeguard, etc. To avoid the nexus between two parties, they introduce faceless. But now again, after the faceless assessment is over, and if the AO feels that the particular case is still sensitive or capable of having some sort of concealment or undisclosed income, asset or expenditure, he can always recommend. So according to me, benefits of all faceless assessments are wiped off in one go by reintroduction of draconian power of Survey 133A. Again, this will be with effect from assessment year 23-24. According to me, all the associations must take up this case, that this restoration of power will lead to gross misuse in the hands of some officers. Now, after survey comes search. Now, survey, search and seizure. These are two related activities under Income Tax Act. Actions. Now, there are some important amendments in the provisions of search and survey assessment. What earlier people were doing, I hereby declare my undisclosed income of rupees 5 crore. But the officer does not know that he has already got brought forward loss of 5 crore rupees. He will set off against undisclosed income and go away. Nothing doing. Now section 79A is introduced, which debars any such set-off. No benefit of set-off of losses or even unabsorbed depreciation. My dear friends, I am repeating, brought forward losses or depreciation cannot be set off against search and seizure. From day one, we have been taught under Income Tax Act that unobserved depreciation can be set off against any head. Then why not against income disclosed under section on survey, search or seizure? No. That means government has decided now that whatever disclosures are made under section 133A3 or 132(4) are over and above normal books of account, brought forward losses, brought forward depreciation, etc., etc., etc. For example, in a survey or a search, 5 crore rupees stock is found, which is undisclosed. Or suppose in a case of a raid on a diamond merchant, there is a gross undervaluation of stock. Similarly, in the case of a contractor, crores of rupees unaccounted cash payments are found, which are detected during the course of survey, search or seizure. There is nothing doing. Section 79A debars such set-off. Again, this is applicable from current assessment year 22-23. My dear friends, may I just remind you in this case, section 115 BBE is already in the statute book, which says that if any addition is made under section 68, 69, 69A, 69B, 69C, 69D, then no loss, no set-off is allowed. But still, the government wanted dead sure that even if the income is disclosed under other sources, other than other sources, the business income, capital gain, etc., then also it is over and above, and it cannot be set off against the income disclosed under search and survey. Now, some small amendment is made that payment of interest up to the completion of assessment or reassessment. Now, another new section is introduced, 148B, which says that no order of assessment or reassessment can be made in the case of search, survey, or acquisition by the AO of rank below JC, except with the prior approval of additional CIT, additional DIT, JCIT, or JD. This is a welcome step for search and survey again, but as you have seen, in one case of ITAT, Sri Lanka Damani, Mumbai ITAT observed that most of the approvals are given in a mechanical way, and that has got no value whatsoever. Now, surcharge. Surcharge on long-term capital gain was as high as 37. Now it is reduced to 15%. Similarly, MAT and AMT also was 18.5%. It has been reduced to 15% for cooperative societies. Similarly, surcharge is reduced from 12 to 7 on cooperative society having total income of less than 10 crore rupees. You must be knowing that now central government has established separate ministry for cooperation. Why? Because government has seen that cooperatives is the largest sector contributing to Indian economy, one of the largest sector. For example, say Amul Milk, it is a cooperative society. Likewise, there are so many giant societies. Now, surcharge or cess, again, this was a bone of contention. On income tax, there is a surcharge, there is education cess, he and she, and it comes to 4%. People started claiming that as an expense. My dear friends, you read section 40, what it says, any tax on income is an income tax and cannot be allowed as a business expenditure. But some high courts, including Bombay High Court, in the case of Sesa Goa, Bombay High Court 1 year before held that this is allowable expenditure. So many tribunals started allowing cess as an allowable expenditure. Some people file even revised returns to claim the surcharge and cess as an allowable expenditure. And there was another judgment of Rajasthan High Court, Chambal Fertilizer and Chemical. There also it was allowed. But now this amendment has been made and made it very clear that surcharge and cess is not allowable business expenditure. And that too is a retrospective amendment. Actually, now some of the high level amendments are coming. Business reorganization. What used to happen is that amalgamation, merger, in the ITO by mistake issues notice to the old company, demerged company, or amalgamated company, or whatever. In the case of Maruti Suzuki Limited, Supreme Court held that notice served to the non-existing company is not valid notice. 416 ITR 613 Supreme Court. Now these amendments have been made to nullify those Supreme Court judgment. Now government has proposed section 170 into bracket 2A that any notice served on the old company, it is as good as notice on the successor company, and these proceedings will be held to be valid. Now another liability is cast upon the assessee that after business reorganization takes place, Section 170A comes into picture, and they have to file return of income, etc., 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 within 6 months from the end of the month in which the order is passed, and intimate that this order has been passed. So all these old judgments have been reversed. Now coming to the TDS, most tedious part of the practice as well as business. Some gentleman has asked me a query to clarify 194R. He may listen it properly now, that new section 194R is introduced. 10% TDS on perquisite or benefit in respect of business or profession passed on to the agent for an amount exceeding rupees 20,000. This is to tax the income under section 28 into bracket 4. Here, let us pause for a moment. I was reading some articles in various magazines today. In one of the articles, one retired commissioner of income tax has written that this 194 applies to salary. No, it's a total wrong interpretation made of 194R. It is not for salaried employee. If it was an amendment for one salaried employment, then it would have come under 192. This is new section. Why new section? What does 28(4) say? It speaks about perquisites under business. Suppose I am an agent of some particular business. He gives me, I give him a lot of discount, but he gives me a free car. Free car, imagine. So that is a perquisite. Similarly, you buy 15 refrigerator and you get one refrigerator free as a dealer. So this is nothing but perquisite in the hand of the agent. Several judgments were there earlier. Rupee Finance, David Dhawan, Helios Food. These have been overruled, and 10% TDS is to be deducted by the person who pays perquisite. So my dear friend, 194R is not for salaried employee at all. It is falling under the head income from business and profession to overrule all these judgments. Another judgment which has occurred and introduced in respect of TDS is TDS on immovable property. Now, as you are well aware, suppose you entered into agreement in 1921, but you are registering in 22. So naturally, there will be difference between two agreement stamp duty value. Now government says nothing doing. You have to deduct TDS on the value of the property, on the amount, either agreement or stamp duty, whichever is higher. Okay. Now, third amendment, which has come under section 201 and 206, that interest on default in deduction of TDS and TDS shall be paid in accordance with the computation made by the AO, which is final. Imagine another draconian provision. Whatever computation AO is made is final. And you have to pay that into government treasury immediately. This will come into effect from 23-24. My dear friend, 10% on the 195 on the perquisite, higher of the property value, TDS, and interest on delayed or non-payment of TDS with effect on 23-24. Now, another amendment which has been introduced, section 239A, TDS liability. There is no TDS liability. but paid to the government. How to claim the refund? So ease of doing business. It says that who has made the deduction of tax under such an agreement or arrangement borne the tax liability, but actually no tax deduction is required. Then they may file an application for refund of such tax deducted before the assessing officer. Such person can, if he is not satisfied, go into appeal. So these are appealable now. Accordingly, the provisions of section 248 will also not apply in cases where the tax payment to the credit center. Simple. So claiming the refund, now this is made appealable. Now, amendment made to the trust. Now, these are some of the amendments which are very, very serious. Penalty under section 271 AAE. Mr. Convener, how much time is left for me? Hello?
विवेक सर को टाइम बताओ और कितनी बची हुई है सर के लिए?
Up to 4 o'clock.
Yes, up to 4 o'clock is definitely there, sir. Please.
And the question answer including or excluding?
Sir, let us find it out. Please carry on till 4 o'clock.
Including question answers.
Including, no, I'll complete my session in 10 minutes more and then 10 minutes for question answer. Okay?
Yes,
that
sir.
okay?
Yes. Perfect.
Okay.
Perfect.
Fine, fine. So new penalty provisions have been introduced for passing on benefit of unreasonable benefit to the trustees. What trustees were doing or specified person? They were taking unusual benefit from the trust under section 11 or covered under section 11 or 12. Now heavy penalties are there. First time violation is 100%. Second time violation 200%. I have seen trust which are squeezed by the trustees and relatives to the worst of their abilities. Now there will be a heavy penalty on them. And as if this is not enough, this penalty is in addition to any other penalty leviable under any other section of the Income Tax Act. New provisions which have been made, the trust availing exemption under section 11 and 12 are liable to maintain books of account in case their income exceeds the minimum threshold before carrying out exemption under 11-12. This is a very, very serious, because most of the people, they were saying that after availing exemption under 11-12, their income is not taxable. So they were not maintaining proper books of accounts and all that. Now that is done away with, and with effect from assessment year 23-24, both the types of trusts have to maintain books of account compulsorily. Section 143.3 is now proposed to be amended. This is very, very dangerous section. I really get scared. Now AO can go to the PCIT and recommend that you withdraw the cancellation of registration of this trust. That means AO's power for recommendation of cancellation and registration have been embedded in section 143.3. This is another draconian power after introduction of 133A. This is second one. Power of CIT or PCI to cancel registration on specified violations are mentioned. Now violations are like this. Income is applied for the other than object of the trust. For example, trust is meant for only for educational purpose, and they have applied for holding a film show. This is against the object of the trust. Trust on institutions has income of gain some business and profit, which is not in, they're carrying on business. Activity of the trust is not genuine. It is a camouflage. This will cover all the trust where in the name of trust, activities of conversion, religious conversion, they are taking place. This will be hit very badly and is non-compliant with other laws. For example, receiving of foreign contribution as per the law is not complied with, then here also I am reminded of one case in which one trust claimed that they have received flat from one devotee, flat in the country of Europe, some country in Europe, say France, and they are claiming directly as a corpus donation. So this is not compliant with the law of the force, because in France there is estate duty. Estate duty was never paid. So how it can become the property of the trust? So several lacunas were there. So if it is not compliant with the laws in force applicable to it, then AO can recommend of cancellation of this to the PCIT or CCIT, etc. And accordingly, we will hold the hearing. Some amendments in nutshell. Explanation 4.5 to section 1023C is providing condition for accumulation of income on non-fulfilling, so that you can study. They have been enlarged. Now, for claiming exemption under section 1023C, under the first regime, return is to be required to be filed. The same is effective from assessment at 23. Now, another issue which was very burning issue, that once there is a denial of expenses, exemption, certain expenses will be still allowed. Expenses include the towards object of the trust, but subject to 48(1)(a), 48(3) and 48(3). So, for example, your trust is denied the exemption of 11-12. Then you will say, okay, give me, I am doing business. So give me examples and exemptions and deductions and allowances of business. Then finance minister, okay. Then you deduct the tax. You can't make payment about 10,000 in cash. Even past liability you can't make in 10,000. So all these are plugged. No expense set off for losses will be allowed under any other provision. So you can't say whatever you disallow here, I will claim under other sections. Now, section 13(1) is amended. Then only that portion of income which is applied in violation shall be included total income, not the whole income. Now, special rate 115 BBI. If the income of the assessee trust includes the income which is specified income as above, then 30% flat rate. No expenditure, no allowance, no set off. Okay. Now, last provision, clarification regarding application of income, that income will be applied in the year of payment and not in the year of incurring the expenses, irrespective of the method of account. What people will do, they will debit bogus expenses and create the sundry creditors which are bogus. So that's not allowed. Application of income means actual payment is postulated. So my dear friends, and one more amendment is that voluntary contribution to temple, mosque and churches, gurudwara, as I told you, where the property is held under trust, then it will specify under 80G. Then expenses on renovation, etc., repairs of these is a part of corpus only if apply such corpus for the voluntary contribution was made, does not apply for making contribution donation to any person, maintains the corpus as identifiable, invest in the deposit under section 11(5). If any of the condition is violated, then it will be taxable. Now, miscellaneous amendment, I will just run through. Conversion of interest into loan or debenture does not amount to payment under section 43B. Now, bonus and dividend stripping are at par with INYT, REIT and AIF with effect from 23-24. Startup companies claim is extended by 1 year. Then extension of last date, that is to 31/3/24 for commencement of manufacturing activity under 115 BAB. Exemption of COVID related donations by employers to employee or family members with effect from 2021, and it is not an income under 56(2)(10) also. It is not a perquisition under section 17 also. Now, TDS limit for state government on national pension scheme raised from 14% to 10%, 10 to 14. Concessional rate of 15% is withdrawn. Now dividend is from specified foreign companies a normal tax, not 15%. Persons engaged in production of cinematic, they have to file form number 52A. This form was earlier, if any contract is entered into film lines above 50,000, within 30 days you have to file. It is reintroduced. Now, Justice Sikri said, in case of Ravi Agarwal, that during the lifetime, if a disabled person receives annuity from parents, this should have been allowed. But unfortunately, it is not allowed. So now Section 80DD is amended to allow that type of annuity. Now, my dear friend, exactly at 3:50, as per the scheduled time, I have concluded my session. And now, questions, if any. If there are no questions, that means everything is either understood fully or everything is bumper. Questions, if any.
Raj Singhania ji.
Actually, there were questions, but since we have disabled the chat box, so
Okay.
people could not put up the questions in the chat box.
No,
So-
no, but some questions were there, Anupji, on chat box.
Okay.
And basically what I
So,
derived
Haraji,
from it
please
that
take those questions one by one, whatever possible within the possible time.
major of the questions were related to provisions of 194R and related provision 37 in case of these perquisite transactions. So one was from Pallavi Gupta with regard to discuss provision of 194R. Mr. Saha has already deliberated on the same. Now, similar question on that respect only, Mr. Manoj Mani Agarwal inquired whether amendment to section 37 is only for medical professionals or it has wider impact on non-salaried directors even.
No, everything.
So
Everybody.
so suppose there are certain directors who are not being paid any kind of remuneration, but rent-free house in the name of the company is being provided to such director. Whether that will be covered by section 37.
As I told you, many people have interpreted these as a amendment of section 192. I don't subscribe to that fully. Whatever comes under 28(4), that has to be construed as the liability under section 194.
Only if it is a business transaction.
Yes, 28(4).
Within the purview of 28(4).
But not necessarily medical.
And not
Medical
necessarily
example
medical.
I gave because that example is very commonly known.
Impact of TDS on perquisite on payment to medical practitioner.
That I have told, no? Same.
That is the same thing. R section 194R and 37 are interrelated. Query from Mr. Rakesh Gupta.
194R is a TDS section and 37 is a disallowance. There are two separate things.
So means his query must be whenever there is a payment which is being covered under section 37, suppose whether the SC is required to deduct TDS in
Yes.
194R.
Yes, and I'm sure that auditor, as an auditor, it is your liability to see whether TDS deductible has been deducted and paid.
If TDS deducted and paid, whether it will.
Deductible, not deducted.
Okay, suppose if it is deductible and paid, whether there will be disallowance thereafter also under section 37.
That of course, no, TDS is only a liability to ascertain. Disallowance is in the hands of the AO. Now, why there is a gap between tax audit return and filing of the return? Tax audit is to be filed before 15 February. Why? Because auditor will quantify. But return will auto-populate all the disallowances in the return at a later date. You just see, mark my word. After a few years, there will be automatic disallowance in the return.
Okay, one query is very simple. Whether 194R is applicable for scheme discount by way of free gift against sale of 100
Yes,
pieces. Suppose,
why not? Exactly, that is covered.
under 194R.
I gave the example of refrigerator and all so many things. No?
I think few persons have raised their hand. Mr. AP Singh.
Sir, one thing I want to ask,
Please,
whether providing foreign to the customers, whether it is will participate and TDS will be applicable.
According to me, yes. Now everything is yes. Lock, stock, and barrel.
On completion of target scheme, the company is providing the foreign tour and other benefits.
So
Then it
you
will
will
be
achieve the target, but after paying tax.
okay.
Can you please explain the impact of the first proviso, which is sought to be introduced to section 149? This is para 47, clause 47 of the bill. What is
Can
the
you read out?
impact?
Because I don't have the copy right now.
It is the first proviso to section 149, which is sought to be introduced, which reads, in the first proviso for the words, brackets, letter, and figure, so and so, so and so, so and so, the following shall be introduced. And what shall be introduced is a notice under section 148 or section 153 or section 153C could not have been issued at that time on account of being beyond the time limit specified under the provisions of clause B of subsection 1 of this section, or section 153A or section 153C, as the case may be.
Yes.
This is sought to be substituted. So what will be the impact of it?
According to, although I have not studied that time limit sections, I generally do not deal in, because these are procedural, but still it's a very important amendment. According to my knowledge, last year there were amendments under 148 and 148A. So such cases could be dealt with only up for 6 years under 153 ABC, and now under new provisions they are up to 10 years. So to cover up this gap of 4 years, actually people were happy that reopening is curtailed. It is not curtailed. It is extended from 6 to 10 years. Only in the case of foreign asset, it has come down from 16 to 10 years, and from non-foreign asset, that is local asset, from 6 to 10 years. So those notices which could not be issued can now be issued. So
But this proviso seems to, I mean, it's okay, sir. Thank you very much, Mr. Shah. But this proviso seems to imply or seems to indicate that this reopening for the years before 1st of April 2021 will continue to be governed by the provisions as they existed before the amendments of 2021 were introduced. So in that case, for those years, it perhaps implies that it would remain to 6 years, but in future it would open up for 10 years. That is what it implies, especially when it is read in conjunction with the explanation that is also provided.
No, but Mr. Gupta, that Mr. Singh, the thing is that last year budget there was a clarification. To my memory, that searches initiated before 31/3/21 were governed by old, and afterwards by new. So they are very amply clarified. So we cannot put more words into the law now.
Okay.
That clarification was already there. That to which provisions old will apply, to which new provisions will apply. It was very clear.
नहीं भूपेंद्र सर, जो सिंपल क्वेरीज की जो मुझे लग रहा ये है कि मार्च 21 के अंदर मार्च 14 के केस जो टाइम बार हो गए थे, 31st of March 21, 31st of March 14 cases were already time barred, and you could not open those cases post 1st of April 2021. So what I could understood from the question, and what is the query in my mind also, whether any AO can open the cases of 31st of March 14 or 13 for that matter, which could not be openable post 31st of March 21 after this amendment in this 22-2 budget.
According to me, yes. Why not?
No, non-search cases. In the non-search cases.
Non-search cases, no.
Our question is non-search cases.
No, non-search cases, no.
Singh sir, I think, am I with you? Like, are we on the same page or you are in a different page?
See, only search cases have been extended from 6 to 10 years.
Okay. I would only request, my reading of the proviso together with the explanation that is provided in the finance bill, seems to imply that for the issuance of notices, even as at, after this approval, considering that this bill is passed in the shape in which it has been introduced, for the years preceding 1st of April 2021, the provisions that applied at that point of time would still continue to apply. That is so, but that really defeats the purpose of what is sought to be introduced in the immediately preceding paragraph, but the proviso seems to indicate that. So I was asking for an expert opinion from you, Mr. Shah, but that's fine.
As I told you, my initial opinion is that as far as search are concerned, they have been extended and remaining will still remain. There is no material amendment on 148.
Right. Thank you very much. You're very kind, sir. Thank you very much.
You're welcome. Huh?
Now Mr. Shah has to leave for another session. We can't take much questions. Only two last questions from Mr. Subir Bose and Rakesh Jain.
No, sure.
Can you unmute Mr. Subir Bose and Rakesh Jain? Yes,
Yes,
Mr.
sir.
Bose.
Mr. Yes, sir, you have told me that the reduction of goodwill from goodwill. Can you hear
Goodwill,
me?
sir.
Reduction of goodwill from the block of asset would be treated as transfer. Now question is that what would be the impact? Is it be capital gain will arise for that transfer, or capital loss will be arise just as a stock in trade in case of stock in trade?
No, it depends at what price you do, na?
So it will be treated as
See, it is a matter of your cost and accounts rather than law, isn't it? See, it
Now
is like that by selling a share, whether I will have a loss or profit, it depends upon your own costing, na?
Right.
Ultimately, I'll tell you, Mr. Sir, I'll tell you, the whole idea is different. Idea is what? People have created fake goodwill, book by book entry, based on Smith's judgment. And those they reduce now. That will be treated as transfer now.
Okay.
The idea is to cover up all the fact transactions. Let me tell you, I mean not because I am telling, idea is simple here. This government is well hell-bent upon all fact transactions, whether it is share capital, share premium, loan, gift, bogus entry, donation, expenses, whatever. That should be genuine and no problem. If it is not genuine, there will be hit somewhere.
Okay. Thank you, sir.
To catch the fake goodwill. Suppose tomorrow I say I have got 10 crore rupees goodwill in my book as a CA practitioner, and then I depreciate. So that should be treated as transfer. Na?
Okay, sir.
The idea is, see, goodwill, last time amendments were based on this theory only, no, basically. Contention was that only. And I do not see any fault in that. It was logically argued by the department. Okay, if I have purchased the goodwill, it is a different matter. Then I should be able to have depreciation. But I create a bogus goodwill in my books and then again claim and introduce somebody as a partner and take away capital receipt. These all are plugged now. 45(4) and 4. And last time we discussed all this. Anyway, but your query is very good and it is very nice query you raised and it's good. Answer is simple. Question is difficult hote hai, answer is easy hote hai.
Thank you, sir. Thank you, sir. Thank you very much.
Okay.
Mr. Rakesh Jain.
Yes, sir.
Mr. Shah, good evening and good evening everyone. Sir,
Yes,
आपने कहा था regarding search cases, undisclosed incomes, unabsorbed losses and depreciation losses will not be allowed to be set off.
Yes.
तो सर इसमें क्वेरी था कि सर्च अगर मिड ऑफ द ईयर में होता है और डिस्क्लोजर हम उसी साल में करते हैं जिस साल में सर्च हुआ और उसी साल में लॉस है तो करंट ईयर लॉसेस विल बी स्टिल बी अलाउड टू बी सेट ऑफ.
No, no, let me clarify. I made it very clear, Mr. Jain. Brought forward losses and depreciation. Section does not speak about current year's losses because that is not known to anybody, no? Not even to me.
Okay, and this is applicable from retrospective effect or prospective, sir?
That I just forgot, but I mentioned the slide. I'll not sure, but that was mentioned in the slide. I'll be giving the slides to you at the end of the session.
And sir, one more small question about the merger matter. A Limited is merged with B and A is extinguished after merger and notice is issued for reopening valid notice to A Limited, but it is already merged. So now the proceeding will start to B
Yes.
Limited. But again, whether these are retrospective or prospective,
No, it is prospective, but they have mentioned that there are two requirements: validity of the notice as well as intimation to the within 6 months. They have to intimate now both the companies that such companies existed, such companies not existed, like that. That both the
Thank you.
sections I mentioned. No.
Thank you. Thank you very much, sir.
Okay, my pleasure. Last line, Mr. Rasingania, before I wind up my session. Correct? Hello?
Yes, sir. Yes,
Give
sir.
me the second.
Continue.
Don't worry about the finance bill and all this thing. Every day you manage your own budget by own thoughts. Leave old thoughts and live with the new thoughts. That is the real finance bill of your own life. Thank you very much for your passionate hearing and see you someday once again. Thank you very much. Good luck to you.
Mr. Saab, just a second. A formal vote of thanks, sir. If you have just will spare 2 minutes. On behalf of VIP Road Chartered Accountant Associations, ACAE, Views Exchange, South City Study Circle, and NCLT Kolkata Bar Association, on all the 5 associations who have joined together to conduct this seminar, I am very much thankful to Mr. Bhupendra Saha for giving his valuable and at this point of time most crunch time, because he's having a lot of sessions to take. He willingly accepted our invitation and presented this wonderful deliberation. I think the provisions he has dealt within has been beneficial to most of the audiences present here. It's all more than 600 to around 700 audience were there at a particular time. Sir, this is a memento which we have.
Thank you very much.
Sir, this has actually been made. I will send it to you by courier. This being presented. Really thank you, Vikas, for presenting this memento to Bhupendra sir, Vikas Watwal from VIPC Association. Sir, very much thankful. It was a wonderful session. As per my understanding, this budget was by the speech of the finance minister, it was simple and non-happening. But when we looked into the fine prints, most of the amendments were made to overrule the judgments passed by the tribunal, not even of the Supreme Courts and High Courts. The judgments given by the tribunals were being upheld and enacted in the law, such a manner and mostly retrospective. So this was my take on this particular budget. Otherwise, there is nothing beneficial to the SSCs much. Thank you, sir. Thank you very much. And now I think we have our second speaker, Mr. Jatin Harjai on indirect taxes. He is present, I think. I now request the organizer to carry forward. Jatin ji, welcome. बहुत दिनों बाद sir. क्या हाल चाल है sir जयपुर के?
All good sir.
Good, चलिए sir.
पूरे देश के एक से हालात हैं.
ठीक है sir. I now request Vivek to carry on the proceedings.
I request Vikas Batwal ji to please read out the profile of Jatin sir. Thank you.
Thank you. Mr. Jatin Harjai is a practicing advocate. He is practiced as chartered accountant for more than 15 years before starting his legal practice. In short span of time, he has become recognized for his contribution and expertise in knowledgeable profession, advisor, and consultant in the field of financial consultancy.
Because may I request?
Yes.
I think most of people are well versed with each other. So I think without going into this, because time is very less.
Sir, 1 minute, sir. 1 minute. Please give me 1 minute. One more minute, sir. Yeah. As we all know, Mr. Jatin Harjai is a very good speaker, but as we have to read a profile for just 1 minute. He is actively engaged in representing industry for the department at various levels and has adopted that for many seminars in almost all the cities of the country. And he is a special invited member of National Indirect Tax Committee of ICI, co-opted member of National Indirect Tax Committee, Tax Consultant Association Bar of Jaipur, and many. There is a long list of him. Now I request Advocate CA Sri Jatin Harjai to give his opinion about our finance bill or regarding indirect tax. Over to Jatin Harjai, sir. Thank you, sir. Now you can start your deliberation, sir.
Whether my screen is visible?
Perfect, sir.
Thank you. First of all, Vikasji, thank you for the introduction. And I understand there's a couple of multiple organizations has come together for arranging this particular talk on budget along with finance bill. So each and every office bearer, executive member, and participant viewer here, a very good afternoon to all of you. The moment budget is here, we all are here to discuss on a very regular basis, daily basis, multiple programs on a daily basis are there to analyze what is there in the budget. To be very honest with you, whenever budget comes, normally people ask us, each and every professional, I would say, how was the budget? How do you rate it on a scale of 10? How much mark will you give it to you? See, as a practice, I'm sure I'm discussing budget. I discussed budget a couple of times in Calcutta as well. But I have never said any budget to be a good, very good, bad, or very bad. See, it's all just like Adam, you must have heard that beauty lies in the eyes of the beholder. So it's a person from whose perspective we are looking at the budget. If I leave the politician side, political parties or the persons influenced by the politics, because we know what they are going to say about the budget. If we talk from the perspective of a taxpayer who may be a businessman, who may be a salaried person, maybe a person who is dealing in maybe securities, and among the business itself, he may be an infrastructure person dealing in infrastructure industry, automobile, or different class of persons. So response of each and every person would be different. I normally say, जिसको कुछ मिला उसके लिए बजट अच्छा था, जिसको कुछ नहीं मिला उसके लिए खराब था. And the person who was expecting that he'll get something और उसको कुछ नहीं मिला तो उसके लिए बहुत खराब था. वो खराब और अच्छे वाली बात तो इस तरीके से करते हैं. Coming to couple of aspects in relation to budget, which I have lined up here to discuss, but I understand that I have been assigned 30 minutes time as I'm a Stepney speaker today. So I'll be limiting myself to the most critical aspects only. I have divided the amendments which are there in the GST law in 6 parts. I'll discuss one part only, which is the most important in detail. Rest I'll try to touch upon, and maybe if there is any query, I'll touch upon them as well. I'm leaving the statistics. I'm sure you must have already discussed. So I'm coming on the most important aspect of the amendment in the GST laws. Before I come to the statutory provisions or the amendments which has been made, let me make a statement. If any person who is a law student or a law scholar or a law researcher, maybe a person who is doing some PhD or maybe some LLM, I must say that implementation of GST law in India can be a model, to demonstrate how badly a law can be implemented in this country from the legal perspective. I'm not on operations or the business or the conduct. How many precedents has been breached? The law has not been followed the way it should be. The supreme law of the country is constitutional. Nothing can supersede that. And what happens whenever any particular law is to be implemented in a particular segment, just like GST is a special law for the levy of taxes on goods and services, on supply of goods or services rather. So there has to be, first there has to be law enactment which is passed by the parliament or the state legislature, which we are having in the form of CGST and SGST Act, along with IGST, UTGST, etc. So first, everything should flow from the Act. Thereafter, the delegated legislature comes into picture. Delegated legislations comes into picture, like rules, bylaws, orders, instructions, notifications. These all are come into play. But only after, when the Act authorizes them. Act means the law passed by the Parliament in case of union, the law passed by the state legislature in case of state. What we have seen in the GST is absolutely reverse manner. Pehle systems aate hain, then some rules and notifications are there, then there is a provision, respective provisions are there in the Act. And this is what has happened in the GST law at n number of places. In this budget, you must have heard from myself or maybe from any other person that these things are there in the GST which are not as per provisions of the Act itself. Maybe some rule, maybe some notification, maybe some order, maybe some circular. And in this budget, government has tried, after realization that tomorrow so many things can be struck down in the GST law, so they have tried to rectify them. And not only rectify, when I'm going to discuss this GST return, you all will realize and maybe may agree with me that government is 2 steps ahead than us. बहुत कुछ नया भी सोचा है उन्होंने जो हम लोग अभी तक सोच ही नहीं पा रहे थे. Probably हम सब लोग बात कर रहे थे कि पीछे वाले सप्लायर ने टैक्स नहीं दिया तो हमसे रिकवरी नहीं होनी चाहिए. If the supplier has not paid the taxes in case of bona fide transaction, the recipient should not be liable to pay tax. The government has gone too far on this. I'll discuss that. Section 38, major amendment, read with 16(2)(ba). Both are new clauses. But before I discuss what is the amendment, it is important to recollect what was the law, or rather what is the law. What is written in the GST Act as on today? Precisely, there are 3 important provisions for filing of the returns and claim of the input tax credit, the process of claim of input tax credit. These 2 things go hand in hand in the GST law. Section 37 outward, section 38 inward, and 39 is the final return. These 3 returns are there in the statutory provisions. 37 says supplier will upload all his data on the common portal. Section 38 says using the data supplied by the or uploaded by the supplier, recipient will upload his details of inward supply, and then he will file, all the taxpayer will file the main return, monthly return in the form of GSTR 3 under section 39. This is what the statutory provision even on today. And very critically, section 38 specifically says that if the data uploaded by the supplier there is a shortfall in that particular data, meaning thereby the GSTR 2A or 2B, whatsoever the form is, ultimately that is a details communicated under section 37. If there is a shortfall or any ITC is not reflected there, then the taxpayer has each and every right to claim input tax credit as per his books of account, as per his own assessment. Just for an example, let us say, as per my books of account, there is a ITC is 5 crore rupee. As per my books of accounts, original actual purchases of goods or services are 5 crore rupee. GST amount is involved. Whereas the GSTR 2A or 2B is reflecting only 2 crore rupees. Then as per section 38, I have every right to claim 5 crore rupees. I completely understand that there is rule 36(4), which was even again modified with effect from 1st January 2022. Even then, the law says so. And this is what one of the important ground on which I have already challenged this particular provision, rule 36(4), that it is ultra virus to provisions of section 38 and 42. If you read section 38, subsection 3 and subsection 42, then it says whatever the difference is there, just like 3 crore in our example, it shall be communicated to both the party, that is recipient and the supplier, for the necessary actions. And thereafter, after that it finally gets to know that the supplier has not paid the taxes and the recipient has taken a wrongful input tax credit, then he is supposed to reverse the credit on the very next month after giving a intimation or a communication in form MIS 01. My simple question: whenever you are receiving the notices of mismatch, have any person received the notice in form or a communication in MIS 01? Answer is no. Law prescribes a complete procedure how it is to be done, but the same has not been followed by any of the authorities. Now, finally, I'm not entering into great detail of that one because, in my humble opinion, none of those notices can sustain it. Anyways, now the government has realized that this kind of mistakes has already been done by them and they are on a course correction mechanism. Apart from course correction, now they have gone one step ahead, which we will discuss. First of all, section 38, which used to say that the recipient is supposed to upload invoice-wise detail on a common portal. It is done away with. It is done away with. Now the recipient is not supposed to file its detail. The notified form was GSTR 2 earlier, though the date was yet to be notified for each and every tax bill till now. So finally, government has officially come to say that it will no more be required after these provisions gets into the statute books. Rather, now 38 says a very, very simple thing, that instead of uploading inward supply details, communication of inward supply and input tax credit. That means government will give a details that whatever vendors has been uploaded to the recipient in a particular form. And we all know the moment government is saying we are talking about GSTR 2A and 2B. When we say vendor, apart from vendor, there may be a prescribed thing. For example, like import of goods. When we are paying IGST on import of goods, it will not be covered by the 37(1). That is why these will come through this prescribed route. So this is what the fine thing. We can understand that through 38(1), they are going to legalize GSTR 2B. One step ahead. Let us go. Now you must recollect that when you look at the GSTR 2B, it already shows two types of credit. One is eligible kind of credit. Second is the credits which cannot be availed. Now the law is saying so that when we are going to provide you the details in the form GSTR 2B, we will categorize input tax credit into two parts. Number one, the credit which may be availed. Number two, the credit which cannot be availed. May be availed mean it is availed by virtue of the details of invoices which are being uploaded and the compliance level of the supplier. But you have to ensure all the conditions are fulfilled at your end as well. For example, receipt of goods or services. It is not just because that you got to have the entry in the GSTR 2B and you take the claim of input tax credit. You have to see whether you have received the goods or services or not, because it is one of the another condition in section 16 subsection 2. That is clause B. That is why the word may is used. You can avail them. This is available. You can avail them. Second is cannot be availed. Now this is what a point which I believe is going to bring very difficult time for the MSME sector, I can say. Let us understand what's going to happen. So precisely GSTR 2B will show two part. Number one, credit which you can take. The credit. Number two, the credit which you cannot take, which you cannot avail. And there is a sixth segment to it, which is there in the section 38 subsection 2 clause B. Let us go one by one, very important. precisely this is what the list, whereby law is talking about affairs of the vendor, of the person who is going to claim the credit. Please mind, it is not the restriction or the details or the description about the recipient or the claimant of the input tax credit. These all are to be seen at the end of the supplier, vendor of the recipient. Number one, starting from one, the person should not be newly registered. That means, let us say on 1st January, a new registration has taken place, and you have purchased something from that fellow on 2nd or 3rd or maybe 5th February or 10th January, then you will not be allowed to get the credit. It may sound logical or may sound with some meeting some objective to the particular persons. Reason being, what I foresee, at least, there is nothing mentioned why these kind of restriction is being placed in the memorandum explaining finance bill. But what I can assume or think about it is, see, we have seen so many fly-by operators. They just used to take registration, maybe in a very short span of time, made the invoices, taken the claim, and after that gone away. Probably to tackle them, this kind of restriction is going to come, in which the government is going to prescribe a particular time frame, that how much newly registered that person is. What I understand is the government should go, or the government will prescribe time limit like 15 days, 30 days, 45 days type of thing, maybe 60 days. And they would like to ensure that by the time the person gets eligible to pass on the credit to the recipient, if required, they get the premises inspected. This is what the understanding must be there in the minds of drafting, while drafting these type of provisions. But ultimately, to pick or to select or to maybe restrict a couple of persons, the responsibility will be casted on each and every person. Each and every newly registered person will suffer from this issue, that for that particular time frame, for let's assume the 30 days time period gets prescribed in the rule. So for that particular time period, actually he'll not be able to issue any invoice, because the people will not buy from him, because the credit will get restricted. Number two, if the supplier has defaulted in the payment, that will also, in that case also, you will not be able to get the credit. What does that mean? Meaning thereby, let us say your client's vendor got some demand. His case came into scrutiny, or maybe one way, another way, or third way, whatever it is. They came into scrutiny. The case was taken up under section 73, 74 for adjudication, and some demand was proposed for whatsoever reason. Maybe classification, maybe exemption, maybe wrongful availment of input tax credit, whatsoever be the reason at their end. But some demand was proposed, and that fellow has not deposited the demand or not agitated the demand in an appeal. In that case, the credit of the recipient will get stuck. Your 2B will show, okay, this is ineligible credit. Now, the biggest problem which is going to populate is, I think this is going to open up Pandora's box, how we need to understand. See, what happened? Let us say there is a client, Mr. Buyer. He has 1,000 purchases invoices from 1,000 different persons. Now, one of the supplier among them, let's say supplier 1, S1, has defaulted in payment, which gets covered by this. And that supplier must have supplied to so many people. It is not that I am the only buyer from him. He must have supplied, maybe like, just like I purchased from 1,000 vendors, he must have supplied to 1,000 buyers. And he is having output demand created by the statutory, by the authorities of, let's say, 5 lakh rupees. So just because there is a default of 5 lakh rupees, whosoever his buyer is, his credit will get stuck because the credit is in the basket. No one can independently identify that which credit or which demand pertains to which invoice. So the issue will be, if my buyer gets a demand which has not been paid, my credit will get stuck. Similarly, moving ahead. If my third condition, if my supplier has mentioned the higher figure in GSTR 1 and put up the lower figure in the GSTR 3B, that means paid the taxes on less amount, then again my credit will get stuck. And what's going to happen? Not only me, all the buyers. Because again, one-to-one matching of the invoices along with the amount in the ECL cannot be tracked. So a person who has paid, who has reflected turnover in GSTR 3B less than the turnover reflected in GSTR 1, each and every buyer will be in trouble. Number 4th. Now they are saying that the excess credit has been availed. Excess credit has been taken by any person. Who? Supplier. Now the biggest problem is who will decide that whether credit, input tax credit, which the supplier has availed, is correct or not. Please mind, if it is to be decided by the proper officer or in the adjudication process, then the demand will get created and it will be covered under clause 2. Then what is for clause 4? That is very, very difficult. That gives an indication or suspicion that during the proceeding the system will also do the same kind of thing. That's going to be a big harassment. Now, lastly, 5th point. If the supplier of my client or the supplier of the registered person for whom we are calculating the credit has not followed the section 49 subsection 12, which is a newly incorporated section, and rule is already there, that is the condition which we know that input tax no one can pay his liability by utilizing 100% input tax credit. 1% he has to pay in cash at least, barring few exceptions. So let us say there is a situation whereby I purchase some goods from someone and he has not paid the taxes by utilizing cash at the rate of 1%. Rather, he has utilized 100% input tax credit. In that case, buyer's credit will get in question. And nonetheless, the last point, abhi list puri nahi hai, government will come up with the rule to add up the class of person in this list. So precisely, this is what type of 2B we will be having in future in times to come, where it will see ITC available, maybe the details put up by the vendors, or maybe like GST paid on import or like. Then ITC which are not available, which cannot be taken from the new registered person, where the supplier is a newly registered, where there is a default in tax payment by the supplier of the recipient, where the supplier of the recipient or the vendor of the recipient has put up greater amount in GSTR 1 instead of GSTR 3B, where the supplier of the vendor, the supplier of the client has claimed excess ITC or not followed the rule 86B. Precisely speaking, all these compliances is to be checked on not on the part of the recipient client for which you are filing the return, rather vendor of the client. That's the biggest problem, the biggest issue which we are going to face in times to come. As I have already said that the government have revamped all these aspects, so there are other conditions as well, so that government has taken some liberty in their hands to come up with some more restrictions. Consequential amendments are there, and again some amendments which were there in line of earlier tax system. That means there will be a matching by the system. So they are being omitted now. Again, the consequential amendment we can say in section 37 and 39 are there. Important. 42, 43 are going to be omitted. This is what the section 42, 43 were there, which used to say there will be a matching by the system. I can take the credit as per my books of accounts, as per the invoices available with me. And now there will be a system, invoice level matching by the system, and system will generate a exceptional reporting, that meaning thereby a reporting whereby some mismatch is there. But since the systems were not working on this particular direction, each and everyone was busy in matching of the credit, maybe with GSTR 2A, which was never mandated by any law. So today is not that topic. That's why I'm not discussing. Simultaneously, 43A, which was introduced in the statute books, though never notified, for the purposes of coming up with the new return filing mechanism, that has also been gone ahead. You must recollect the return forms like Sahaj, Sugam, etc. So they are not going to come any day anymore. So precisely, government has officially declared now that they are not coming up with any kind of return filing system. Ultimately, the system which are going to be strengthened further will be GSTR 1, GSTR 2B, and GSTR 3B. This is what is going to happen ultimately. One important, or I must say very important, is amendment in section 41. See, 41 used to say that whatever credit we are taking is on a provisional basis. And when it will become final? After due process of matching of section 42 and 43. That means, first of all, whenever you are going to take credit in your records on the basis of your return, it will be provisional. And it will get matched by way of GSTR 2 and 1A. And once it is confirmed matched, then it will be final. Now we know that 42 and 43 are gone. So accordingly, this is also substituted. So the concept of provisional credit is done away with now. Here it's an important thing. Please mind, whenever you receive a notice that the supplier has not paid the taxes, you can very well reply till the period this amendment comes into force. That means 17, 18, 18, 19, 19, 20, 20, 21, 2020, 21, 22, and 22, 23 as well, till the time it gets notified. That requirement, whatever credit I have taken, other than matching, you cannot deny them, because the requirement that supplier has to pay the taxes is in section 16(2) clause 3, so clause C, and that is subject to section 41. And 41 says you can take the credit on your as per your return, then there will be a matching of 42, 43, and matching is not there, so you cannot deny me. Number one. Now every credit after this amendment, it will be a provisional credit concept will go away, and whatever I am going to take in my return should be correct one as per my self-assessment. So that means there are more responsibilities on me. Simultaneously, subsection 2, which are done away with now, is very important. You must recollect Jyoti Construction versus Deputy Commissioner Central Taxes, Odisha High Court recent judgment 3 months back. Odisha High Court has specifically said that when you are going to file the appeal, you have to pre-deposit the amount required in section 107 through cash ledger only. That means you cannot utilize input tax credit. I don't know whether intentionally or unintentionally. By this amendment, the ratio of this judgment gets diluted. Because when you will refer to Jyoti Construction, the whole decision was based on this particular 41 subsection 2, which used to say that the input tax credit which is taken in return shall be used for the output tax only. And output tax is a tax which has been reflected in return. Output tax. That means if there is any case you are going to file the appeal against the disputed tax. So disputed tax which you have never reflected in return is not your self-assessed tax. Number one. Number two, input tax credit. Again, the same ratio that you cannot utilize input tax credit for filing of the appeal, pre-deposit amount of the appeal. This is what the held by the Odisha High Court, and it was based on section 41 subsection 2 and by substitution of subsection 41 subsection 2, omission of section 41 subsection 2. I believe now the previous position will get restored and appeals can very well be filed by utilization of input tax credit. This is what my view on this. Couple of other things are there or more there in respect of 41, which I think due to paucity of time I should leave now. Just a linkage. I'll be very quick to describe these things. See, section 16 subsection 2 is there, which prescribes the condition. A, B, C, D was the original one. Then in last year, we came up with the new one that the supplier has to file GSTR1. His GSTR1 must be filed. And now we came up with compliances of section 38 has to be done. That means the restriction given in the credit should not fit into the restriction given in section 38. So you can understand or you can have understanding that the what kind of how the entitlement of input tax credit will go away in the GST in times to come will be like this. That is on your screen. With the inception of law, there were 4 clauses, A, B, C, D. I have differently given a color to the different clauses. Let me make you understand why I'm saying what I'm going to describe here. Clause A, Clause B, and Clause D. Having tax invoices with you, receiving of the goods or services, and filing of the return by the recipient are all in the hands of the recipient, and he can ensure that he complies with the condition. Clause C of the payment of taxes, which was there originally, Clause AA, which was introduced last year, and Clause BA, which is introduced in this finance bill, in my humble opinion, are not in the hands of the recipient to comply with. These points will go up to higher hierarchy in the courts. And I'm sure that on the principles of non-lex cogit ad impossibilia, ultimately these are going to be read down. That you cannot expect from a person to do something impossible. A buyer cannot control the level of compliances of the supplier. So in nutshell, if I'll summarize, whole of the amendments are that whatever the practices being followed, they were being taken in the rules and earlier, and now the same are being taken in the act. So blessing in disguise we can find here that please mind whatever the issues or whatever the cases in relation to input tax credit are there with all of you. Please mind if you apply these principles that at first it has to be in the act. Then correlate all these aspects along with the judgment like Sunday came from the Honorable Madras High Court. One can make sure that all the credits can be claimed by them. I'm getting a call from the organizers, so I understand that they want me to sum up because I have already exceeded the time. So with this, I'll conclude. I'll be sharing my presentation with the organizers so that one can go through with all the amendments in relation to the GST law. With this, I think I should rather conclude. Thank you. Thank you for giving me this opportunity to share some of my thoughts on the GST aspect. Since there was possible time, I could touch only one aspect, but I tried to touch the most important aspect. Thank you. Thank you very much to each and everyone.
Sir, with your permission, I think you'll be holding back till 5:30 so that we can have a 15 minutes question answer session at the end.
Till what time?
Till 5:30 is the max, sir. We'll be ending the capital market session by 5:15. It's half an hour time frame, sir.
I'm sorry, that will be difficult for me. I'm scheduled for some other program.
Okay.
So I request CA Naveen Singhal kindly give formal vote of thanks to our speaker, CA Advocate Jatin Harjai, sir.
Thank you so much, sir. Sir, you are not a Stephanie. We are looking for more sessions from you. I'm a personal fan of yours. It's an honor to have you on board, sir. I, Naveen Singhal, on behalf of all the participants and members, thank Jatin Harjai, sir, for his presence. I'm pretty sure the precious knowledge that sir has given us will definitely help us in a day-to-day work. Sir, thank you is not enough, but as a matter of extended thanks, I request CA Naveen Khemkaji to offer a digital token which shall be physically delivered to you later on, sir. Naveen, bhaiya, I think the token.
I will share, sir. In the meantime, I will share.
Sorry, I got disconnected. Bajrangji?
Yes, sir.
I'm sorry that it will be difficult for me to re-log in again.
Okay. Okay. Oh.
Sir, this is just a memento from the organizers.
Naveen, please continue with your vote of thanks, please, for Jatin ji.
Okay. Sir, as a matter of extended thanks, I request sir to offer a digital memento which shall be physically delivered to you, sir. And thank you all the participants for listening to sir so patiently. Thank you so much, sir.
Thank you, sir.
Thank you, Jatin ji. Thank you very much.
Thank you, sir.
Thank you, Jatin ji.
Thank you, everyone.
Friends, Shivani Sarkar Kurian madam has already joined our sessions, so I request CA Naveen Singhal ji kindly introduce Shivani Sarkar Kurian.
Shibani ma'am has PGDM specialization in finance, BSc honors economics. Ma'am has a total experience of 20 years, out of which in the Indian equity markets, of which almost more than 12 years have been with Kotak Mahindra Asset Management Company Limited. Her primary responsibilities include equity fund management and heading the equity research team. Prior to joining Kotak Mahindra Asset Management Company Limited, she worked for almost 6 years with UTI Asset Management Company and for 1.5 years with Donny Day AV Financial Services. She holds a PGDM with a specialization in finance from TAPAI Management Institute, Manipal, and a BSc honors from St. Xavier's College, Kolkata. All of us welcome you, ma'am, on board. Please share your thoughts and oblige us. Over to you, ma'am. Thank you.
Thank you so much, Naveen, for the very kind introduction. Good evening, everyone. So we've had a great budget that was presented on the 1st of February. And I will just take a brief moment to share some of our thoughts and the impact of the budget that we see in terms of the equity markets. So if you will give me a kind permission to just share my screen so that I will put up my PPT. I hope, Naveen, this is visible to you.
Yes, it is. Yes, ma'am. Yes.
Thank you so much. So this budget was unique in its presentation, in the fact that, one, it was a budget where the finance minister spoke from a digital iPad, and clearly the budget was a pro-growth budget with a thrust on capex spend. Over the last 2 years, I think the government narrative in terms of policy change has clearly shifted towards creating infrastructure and investments, which is likely to aid growth, not just over the next 1 or 2 years, but a period of 25 years, is as they have called out in the budget. Now, why investment growth? Now, investment growth clearly has a multiplier effect on GDP, which is higher than what it is for spurring near-term consumption. India, over the last 2 decades, has primarily been a consumption or a services-led economy. And now some of the policy initiatives are being taken to ensure that we are not just a consumption-led economy, but there is some impetus given towards investment and long-term sustainable growth. So with this background, let me run you through some of the key themes of the budget, also some aspects of fiscal maths and its impact on interest rates, and then some of the impact across a few of the sectors where the budget proposals are concerned. So as I said, this budget clearly is a budget which focuses on growth. Now, this growth is led by CapEx. So if you look at the total expenditure growth number that the budget talks about, overall expenditure growth is actually muted. But the capital expenditure is budgeted to grow by almost 24.5% in FY23 over the revised estimates for FY22. So therefore, what they are really saying is that the heavy lifting for growth will be done by public spend on infrastructure. And therefore, the budget itself is taking on balance sheet the spend that is required to spur the investment growth. The second key area that the budget talks about, and this is actually the first time the budget is talking about, is the energy transition and climate action needed to reduce the carbon footprint. So we all know about the production-linked incentive scheme, but this time around, specifically, the budget talks about additional support of 195 billion for solar module manufacturing. And this is to reach the 280 gigawatt solar power, which is the outlined target by 2030. Now, in terms of the budget math, what we need to understand is that usually we talk about the budget. Sorry, can I request everyone to put their thing on mute, please? Yeah, thank you so much. So normally when we look at the budget math, it does appear in some cases the math is stretched. However, this time around, the budget assumptions are actually on the conservative side. Now, remember, the economic survey came out one day before the budget, and the economic survey talked about real GDP growth in FY23 at around 9%. However, the budget assumption is taking 11.1% as the FY23 nominal GDP growth. And therefore, our belief is that there is possibility of upsides, especially given the kind of economic recovery that we have seen so far. The second aspect is that the net tax revenue is budgeted to grow by only 9.6% in FY23 over the revised estimates for FY22. And this is in fact lower than the nominal GDP growth. And therefore, again, the tax numbers look to be on the conservative side. And for FY23, the disinvestment target this year, unlike the elevated target that they had last year, is only at about $650 billion or rupees, sorry, which is 65,000 crores. Now, there are certain challenges in the budget. First, fiscal consolidation is clearly moving slower than expected. So we are talking about 6.9% fiscal deficit going to 6.4%, but they have said that they will reach a 4.5% deficit target by FY26. However, they have not laid out any kind of roadmap as to how they will reach the target over the next 2 to 3 year period. The gross borrowing target is something that the market was actually estimating to be a lower number. And therefore, the FY23 gross borrowing number as well as the net borrowing number was higher than market expectations, which is why the yields moved up post the announcements of the budget where the 10-year GSEC yield is concerned. And therefore, from here, while the policies are all laid out, execution of the growth agenda will be the key. Now, last year also, the budget had talked about capital expenditure growth. However, if you look at the actual expenditure, which is the 9-month figure, the expenditure is only at about 70% of the budgeted amount. And therefore, spending has been actually lower than what was budgeted. And hence, from here on, while the direction is correct, the execution of the growth agenda would be very, very critical. Now, let's look at some figures in the budget. Now, we've talked about the broad fiscal deficit target, which is 6.4% and 6.9%. But like I said, the revenue growth is muted. So it's only budgeted a 6% revenue growth in FY23 with tax revenue growth of 9.6% and non-tax revenue, which is essentially dividend surplus, etc., coming from RBI and other PSU entities, actually declining in FY23 over FY22. So therefore, the total receipts growth is actually only 3%. And again, the disinvestment target this time around is at 650 billion vis-a-vis 780, which is what is the revised estimate for FY22. And the revised estimate possibly takes into account maybe the LIC disinvestment. And this is significantly lower than the target that they had set in FY 21-22, which was 1750 billion. Now, on the expenditure side, one good part is that capital expenditure as a percentage of the total expenditure has increased to almost 19%. However, remember this capital expenditure of that they're talking about includes a 1 trillion transfer to the states for capex. So the government is also saying that they will put the onus of capital expenditure and investment growth on the states as well, and that transfer is happening via the balance sheet of the budget. Now, the good part is that all expenses have now been put on the balance sheet, so there are no off-balance sheet items. So what you see is what you get, and therefore compliance clearly has improved, and communication is very, very clear in terms of the numbers that are being presented in the budget. Now, when we look at the market borrowing number, as we said, now because the fiscal deficit for FY23 is budgeted at 6.4%, the actual borrowing number is significantly higher than what is the revised estimate for FY22. Now, does this mean that yields are going to stay high? Now, there are a couple of aspects to look at. When you look at financing of the fiscal deficit, if you look at the number, you will see that the financing through the small savings scheme, which was at 5915 billion in FY22, has actually been brought down in FY23. Now, if the interest rates slightly rise from here on and the government is able to mobilize more through the small savings scheme, then there is upside here in terms of the number, and that could have some bearing on the net borrowing number. Also, remember in the previous slide, I showed you that the nominal GDP itself is only 11.1%. Now, if you are assuming that real GDP growth is anywhere in the range of 8 to 8.5% in FY23, with inflation at about 4.5-5%, the nominal GDP growth number itself will have upsides for FY23. And therefore, tax revenue, which is budgeted at only 9.6%, itself can have upsides. So what we are saying is that this net borrowing number, which has resulted in the bond markets reacting to the budget in terms of yields going up, could have some upsides from here on. And therefore, this is the number to watch out for. And also, most importantly, RBI's action in terms of policy rates will determine the path of yields. We believe that RBI will move towards normalization, but they will do so at a very, very gradual pace. Next policy, which is in February itself, they will possibly keep rates on hold while talking about how they will move towards policy normalization and removing excess liquidity from the system. Now, while the Federal Reserve has moved towards a very hawkish stance, RBI is likely to take a more measured path where policy rates are concerned. So we would believe that some of these numbers, which are looking extremely high on the borrowing side, will likely see some moderation going ahead. And this is what we will really watch out for. Now, let's take a closer look at the tax breakup. Now, when you look at the tax breakup, direct taxes are budgeted to grow at 14%. And indirect taxes are budgeted to grow only at 6%. So in case of indirect tax, the excise duty is factoring in some lower fuel tax. However, the direct tax growth, while it is 14% and slightly higher than the nominal GDP growth, remember this growth in FY22 was almost 32%. So what the budget is really saying is that despite the great traction that we are seeing in terms of direct tax collections in FY22, they expect that the growth will actually come down in FY23, which again seems to be extremely conservative. And therefore, tax revenue as a percentage of GDP remains flat at about 10%. And the other point to note is that in terms of the non-tax revenue, one, we already spoke about the disinvestment number coming down from 780 to 650. This 650, if the government really goes through with the scheduled disinvestments, will be easy to reach. And secondly, in terms of the telecommunication dues, which is through the spectrum auctions, as well as the normal yearly dues that you get from the telecom sector, that number has also come down from 720 to 528 billion. So net, if you look at the total receipts number of the government in terms of the budgeted number, the growth seems to be fairly muted at 5%. So it appears conservative, leaving room for some upsides. Now, as I was saying in the last chart, this chart is important because if you look at here in FY22, the revised estimate, which is your blue line, and the green line, which is your FY23 numbers, the growth across the board seems to be coming down. So whether it be income tax, corporate tax, customs duty, GST collection, and non-tax revenue. And therefore, it is expected, the kind of growth and economic recovery that we are seeing, there could be some upsides to the number. In fact, if you look at FY22 numbers by itself, 9-month numbers show that revenue collection and tax revenue collections have grown at 44%. And the FY22 revised estimates in the budget assume only a 24% growth over FY21, which means that even if no taxes are collected in the next 3 months, you will possibly be higher than what the budget has estimated. And therefore, the numbers appear to be extremely conservative while projecting the data. On the expenditure side, I think the direction clearly is positive. So firstly, on revenue expenditure, and the most important component of revenue expenditure is subsidies. And across the board, there is budgeted decline in subsidies. So food, fertilizer, oil, all three components are seeing lower subsidies being accounted for in FY23. However, interest payments, which is again a pretty large part of the revenue expenditure, is going up. And this is something that possibly constrains overall budgetary expenditure, and revenue expenditure as a component is something that the government will have to work in terms of bringing it down. Now, until and unless they're able to get this interest payment number down, it's very difficult for the budget to find space on a sustained basis for capital expenditure and overall expenditure growth. Now, on the capital expenditure side, if you look at the breakup, clearly three key areas: roads and highways, railways, and defense. So the total capital expenditure growth of 24% includes 1 trillion, which is going to the states on an interest-free basis for use for capex. But the rest of, if you look at the breakup, clearly these are the three key areas of focus for the government. The fourth area is housing, and they have spoken about the Pradhan Mantri Awas Yojana and the outlay of 480 billion. But remember, last year also there was an outlay of almost 470 billion in the budget for the Pradhan Mantri Awas Yojana. So on a growth basis, the number is not a significant number as such. But what is important to note that the share of capital expenditure to total expenditure rises from 16% to 19%, and subsidies are projected to fall to 1.2% of GDP. Now, when we look at capital expenditure, there are two parts of capital expenditure. So as you know, there is budgetary support, and then there is extra budgetary support, or something that comes out of the budget, but through the public sector undertaking. So when you total up the budgetary allocation for capital expenditure plus the extra budgetary number, the growth in overall capex for FY23 is 10%. And therefore, vis-a-vis the 24.5% budgetary allocation, the actual growth is 10%. Therefore, one may ask that is the actual capital expenditure focus lower than what is seeming on the paper? The answer to that is actually no, because when you have budgeted numbers for capital expenditure, the pressure on ministries to actually spend that number is high. And therefore, more focus comes when you actually budget for it on union budget financials, rather than asking the public sector enterprises to spend on it. Also, remember, FY22 number for capital expenditure includes 520 billion, which is on account of capital infusion to Air India for past liabilities. So adjusted for this, in FY23, government capex actually increases by over 35% on a YOY basis. So that's a really large number from an overall budget perspective. Finally, if you look at interest payment, and this is what I was talking about, interest payments as a percentage of revenue receipts is very high. So it's over 40%. And until and unless you're able to actually bring down your interest payments as a percentage of revenue receipts, the room that the budget has in terms of spurring capital expenditure will always be limited. And you will always have to juggle around to find that extra push to ensure that GDP growth gets the boost that it requires. And therefore, from a government perspective, you will need to find a way to actually rationalize your revenue expenditure. They've done a great deal on the subsidy front, but so far, interest payments is something that they will have to take into account. And with interest rates now on the way up, this will be an area of concern where the overall budget goes. Now, we've spoken a lot about the infrastructure side, but I just wanted to talk about the outlay that they have done. There are three key areas where the outlay is clearly growing. So first is the Jal Jeevan Mission, which is the National Rural Drinking Water Mission, where increase in FY23 budget estimates over FY22 is 33%. The second is the road sector, which is the Pradhan Mantri Gram Sadak Yojana, where the increase is almost 36%. And then finally, there is also growth in railways, where there is 17% growth, and defense with growth of 10% in terms of the total outlay. Therefore, these are the few key areas where the government is focusing on. So the water mission, which is Jal Se Nal. The second is the road segment. Third is railways. Fourth is defense. And where the Pradhan Mantri Awas Yojana is concerned, the allocations remain largely steady over the last year. Now, let's also look quickly in terms of how the sectoral impact is. Now, overall, this has been a fairly positive budget. So whether you talk about banking, financial services, infrastructure, real estate, capital goods, cement, the impact has largely been positive. I'll just run through quickly some of the key sectoral highlights which wanted to bring to your notice. Now, firstly, in terms of banks, the budget, of course, talks about growth acceleration, and therefore this is positive from an outlook for credit growth. However, there was no announcement vis-a-vis the recapitalization of public sector banks that is usually put in the budget. So that is something that one would have to watch out for. There has been the extension of the ECLGS scheme, which is credit facilitation for the MSME segment, and mortality and related sectors. And this is positive from the MSME side. And finally, the budget also talks about introduction of a digital currency, and this is something to await when RBI comes out with the announcement. Now, infrastructure across the board is positive in terms of its allocation, and we've spoken a lot about roads, railways, Jal Jeevan Mission, etc. And similarly, so for capital goods. Now, one factor that I wanted to bring to notice is the additional allocation of 195 billion for the PLI scheme for manufacturing of high efficiency modules in terms of the solar PV modules. And this would therefore be another step to boosting manufacturing in India, and also a push towards carbon emission reduction through the incentivization of solar energy usage. So this is a key factor which is positive from a capital goods perspective, as well as from the overall move towards a reduction in carbon emission. Cement and building materials are positive. One, of course, the thrust towards roads. Second is the allocation for the affordable housing scheme, which continues to remain positive. Cement, as you know, demand comes both from housing as well as from the infrastructure segment. Finally, in terms of a few other sectors, one to note in the only negative is in terms of agriculture, where the total subsidy allocation is actually lower in FY23 vis-a-vis the number for FY22. And therefore, because of the reduction for subsidy on fertilizer companies, this could be a negative, which we need to watch out for. And the second factor to note is that the Manrega, which is the National Rural Employment Guarantee Act allocation, has actually been reduced by 26% to 730 billion from 980 billion in FY22. So this is again another factor that we need to watch out for where rural India is concerned. On the consumer side, there has been no significant change in taxation, which itself is a positive. And in autos, one big factor would be the policy for battery swapping with interoperability between players. And this is a positive because it will result in faster adoption of EV technology, especially in the two-wheeler space. So overall budget was positive from an auto sector as well. And finally, if you look at oil and gas, again, it's been largely neutral. One is that the petroleum subsidy allocation has been slightly lower, but it is more or less manageable. Also, there has been an additional excise duty that has been imposed at rupees 2 per liter on unblended fuel. And again, this is mostly going towards government's target in terms of increasing the component of blended fuel in order to ensure that the dependence on oil as part of the transportation fuel requirement comes down over a period of time. So this is, I think, something that we will have to watch out for. Clearly, the government is talking about adoption of hydrogen and green hydrogen becoming more viable, and they're also talking about fuel blending. And all of this is designed to ensure that there is adequate move towards blending of fuel. On pharmaceuticals, lastly, before I stop, nothing significant. It's been neutral to positive. There has been slight increase in terms of the Ayushman Bharat outlay, as well as for the National Digital Health Mission. Now, what the government is also talking about is creating like what we have for UPI, is to create a similar sort of an infrastructure on the healthcare side, where all healthcare records, accessibility, etc., will be on a digital platform. And this will ensure that one, healthcare becomes more accessible to people across India, and also where that your hospital records, etc., which are often in all physical form, becomes digitally accessible to everybody across doctors, across hospitals, and therefore sets up a system which would be similar like what we have seen in digital payments where the UPI is concerned. So I will stop here and will be happy to take any questions.
If any questions is there, you can take up. I don't think there are much questions in the chat box.
Sure.
Just for my knowledge, ma'am, looking at the prospect what we have discussed, that the budget is overall good in every sector. So looking at the prospect of market, where we generally, the chartered accountants, would like to know that whether the market will be going positive or negative. We have always heard that the budget sentiments impact the market. So what would be your key takeaway point, that the market is going to, because we are seeing a negative impact because of COVID and Corona also. The industries have not reached to their potentials, wherein they can give balance sheet point of view of good revenue, but still the market fund is moving in. So looking at all those factors, what would be your take that whether the market is going to in the next 3-4 months time?
So one is that the budget as an event and its impact on the market is diminishing with every year. So this is because the key structural policy announcements are not limited only to the budget, and therefore the impact of the budget on market really has been coming down. So that's number one. When we look at markets, we have to look at it in two time periods. One is the very short term, and second is a slightly medium to long term view on equity markets. Now, when we approach equity markets as investors or mutual fund participants, where we are looking to invest, we are looking at markets over the medium to long term. Now, on the medium to long term, India clearly is on a structural uptrend. There are three key drivers of the market at this point in time. One, corporate profitability has improved. So if you look at corporate profit to GDP ratio, touched a low in FY20. And then from then on, the market has seen the corporate profitability actually starting to rise. And we believe that at this point in time, we are in a new profit cycle. Second, we spoke a lot about CapEx, and therefore the CapEx cycle is clearly turning. And thirdly is the policy environment. However, when we look at market earnings, we also have to look at valuations. So today, in the last 1 year, India has been among the best performing markets in the world and in the emerging market pack. And therefore, India's valuation, both in terms of absolute as well as relative valuations, are at the upper end of the valuation band. And therefore, valuations are expensive. Also, what we have been seeing in terms of corporate earnings is that while the earnings growth has been strong, the pace of earnings upgrades has started to come down. And therefore, we believe that in the near term, given the valuations that we are trading at, there could be some volatility in the market. And that is something that we are actually seeing even today. Globally, there is a risk-off sentiment that has come, and that's an outcome of the Fed stance. The Fed stance clearly is, which meeting which took place on 26 January, shows that the Fed is looking to raise interest rates. There is a lot of debate whether it be 4 rate hikes or 5 rate hikes. And therefore, the easy monetary policy that we saw over the last 2 years is now coming to an end. And therefore, near term, there could be volatility. However, with this backdrop, we are actually looking at 5 key themes in terms of sectors to invest in where our overall strategy is concerned. First, we are looking at the capex cycle reviving, and therefore we are looking at domestic cyclical sectors such as infrastructure, capital goods, manufacturing, and cement. The second is the household capex, and we believe that real estate cycle is clearly improving on the back of lower interest rates that we have seen, affordability as well as policy. And therefore, real estate and home building is another segment that we are positive on. The third is on financials. We believe that private sector banks, especially the large private sector banks, are extremely well placed in this current environment. Growth is picking up, therefore credit growth will also likely pick up, and their asset quality issues are now behind them. And even though we are navigating through Omicron, you would have seen that most of the state governments have actually lifted all the restrictions. And as each of the COVID wave comes, the impact on the economy is likely to get lower and lower. The fourth theme that we are looking at is the export opportunity and the China +1 strategy. So sectors, for example, like chemicals is very well placed in this sort of an environment to capture market share from China. And finally, we are looking at digital adoption. So COVID started an acceleration of digital transformation, but our belief is that this digital transformation journey is not for only 1 year or 2 years. Companies will see this digital transformation journey play out over the next few years. So these are some of the few sectors and themes that we are positive on from a slightly medium-term perspective, notwithstanding the volatility that we are likely to see in the near term.
Thanks a lot for that update, ma'am. Just a small thing that in the last year budget, we have seen that the Indian economy has focused on the electric segment of vehicles. This year budget, we did not hear much about those things. But looking at the prospect that the electric market is going to boom and the commercial auto industry is also going to boom. So your takeaway points with respect to auto ancillary and auto industries, ma'am.
Yeah, so the auto sector actually, as you know, over the last 5 years has gone through a tremendous amount of pain. So cost of ownership has gone up, regulatory changes have taken place, so which has all impacted automobile sector. So let's look at it in 3 parts. Firstly, in the passenger vehicle segment, we believe that demand growth in the passenger vehicle segment is improving quite sharply. Now, while there is transition towards EV, but that transition is happening more on the two-wheeler space, mainly in scooters. On the passenger vehicle side, what we have seen is that inventory levels in the system are extremely low at this point in time, and demand and volume output is impacted mainly because of the semiconductor shortage. This shortage should actually start to come down over the next few months, and therefore there is scope for volume growth to bounce back where passenger vehicles are concerned. On the scooter side, there is significant amount of disruption. As you rightly mentioned, there are many players who are coming into the market because of the EV thrust. However, in this space, while there is disruption, those players who are actually now investing on the EV side, they are getting into tie-ups, and players who cater to the rural or to the bottom of the pyramid market, those players are still well placed. However, our preference at this point of time is for passenger vehicles over two-wheelers, given the fact that two-wheelers will see some amount of disruption over the next few years until the market really settles down. Now, while the government did not talk much about EV in the budget, but clearly the focus and thrust on EVs remain. So because two-wheeler subsidies in terms of EV subsidies are very high, and as you know, the GST rates for EV two-wheelers are significantly lower than for the ICE engines. So the government push on two-wheeler strategy, especially where EVs are concerned, will continue. And finally, coming to the commercial vehicle segment, again, this is a segment which has seen very muted growth in the last many years. But as the economy recovers, this segment will slowly start to recover, but recovery will possibly be a little back-ended. Also, oil prices is something that we have to watch out for in terms of fuel costs. And as a result of which, in terms of preference at this point in time on the auto sector, we have the passenger vehicle segment, two-wheelers, and then the CV segment.
Yes, ma'am.
I would request Bajrang Narwaji to kindly conclude the session.
I know, ma'am, you are getting late. I want to ask two more questions. One from C. Narendra Kumar Shah. He throw the, do madam, you feel there is a disconnect between market and economy? If not, how? And second query is from
Sanjay Chaudhary ji, with
Sanjay.
aggressive government of India spending, would interest rate by RBI go up?
Yes, ma'am.
Yeah. So on the RBI front, I think RBI will take measured steps towards policy rates. So I think they will not hike this time around, but they will start hiking policy rates maybe in the next policy. However, it will not be a very sharp increase in interest rates where policy rates are concerned. So RBI has clearly said that they don't want to disrupt growth by hiking interest rates very fast. And therefore, whatever action happens from RBI side will be very, very measured. The second question, which was on disconnect between markets and economy. So when markets are looking at the economy, they are clearly looking at the formal economy. There is a lot of difference, and this time, as many people have pointed out, the recovery is K-shaped. So there is a segment of the market, which is the formal economy, which has actually gained in terms of market share. And the segment which has been impacted has been the informal economy or the unorganized segment. So there is a disconnect from that aspect. But if you look at corporates which are listed in terms of the markets, those corporates have actually seen gain in market share. They have seen deleveraging of their balance sheet, and cash flows from operations have gone up across the board. So therefore, the output in terms of actual return ratios for corporates have gone up over the last 2 years, despite the COVID-related struggle, and market is clearly valuing that. And therefore, that's what we need to look at when we are analyzing the market.
Yeah, thank you, ma'am, for your wonderful sessions. I, Bajrang Agrawal, President of BIP CA Association, along with ACA, Views Exchange, South City Study Circle, and NCLT Bar Association, must say thank you for your word of wisdom. I am sure all the members, delegates who present here will must get benefit from today's sessions. Now I request CA Rahul Rungta, Secretary of BIP CA Association, kindly offer a e-memento to Shivani ma'am.
Yes, Bajrangji.
Thank you so much.
Shivani ma'am, it is my honor to share this e-memento to you. Although it's an e-memento form at this point in time, ma'am, but we will ensure that we are able to send this across to you in the physical format so that it can get a pride of place in your office, ma'am. Thank you very much, ma'am, for your time and for your wonderful deliberation.
Thank you so much. Thank you so much for inviting me, and I wish you all that you stay safe, and thank you very much.
Thank you, ma'am.
Thank you, ma'am.
Now, yeah, thank you, ma'am. Now I request CA Rahul Rungta kindly give a formal vote of thanks to our delegates and associations and conclude the session. Thank you.
Thank you. So it is my absolute pleasure to offer a formal vote of thanks to all the 5 organizing associations, ACA, WIPCA, Views Exchange, South City Study Circle, and NCLT Bar Association. I think it has been great that instead of us organizing nuclear events, we have been able to partner together and organize a joint event, which has been pretty successful. So thank you everyone, all the presidents and office bearers from all these respective associations for your kind coordination time and for allowing us to organize this wonderful event, and it has been conducted smoothly. I would also like to thank our past president Raj Singhania and all the other coordinators who had coordinated with the speakers and had lined up such galaxy of speakers for us. It would have been great if we would have been able to hear Girish Ahuja sir as well, but due to unavoidable circumstances, we could not hear him. So thank you everyone, and I would also like to thank each and every participant for joining us for this session and for making this session a great success. Thank you, and I hope you enjoyed it. And with that, I think that's it. So please take care, stay safe, stay healthy. Thank you. Thank you, everyone.
Thank you.
Thank you, everyone.
Thank you, everybody.
I'm ending the meeting here. Thanks a lot.
Thank you.